A very good morning to everyone present. This side CA Aishwarya Jaju, and I am honored to welcome our guests for this pleasant Sunday morning, CA Ravi Kumar Somani sir and CA Abhay Desai sir. I also extend a warm welcome to our Vice Chairman of Pune ICI, CA Rajesh Agarwal sir, and all our enthusiastic participants. It's really wonderful to see all of you present here for a hot topic of discussion, analysis of changes recommended in the 47 GST Council. So most of them must have already gone through these changes कि client ने forward किया sir ये change आया अभी क्या करना है. So let us just analyze these changes through the lenses of our speakers today. Before opening the platform to our speakers, I would request CA Rajesh Agarwal sir to welcome our guests.
Good morning, Ravi sir, Abhay sir, and all participants. Actually, I should thank to Ravi sir and Abhay sir for accepting invitation and joining this session, today's session. I think most of our participants are waiting for the notification instead of recommendations, but we should prepare at earlier stage what is the recommendation. We should get prepared because notification will get effected on the date of issuance of the notification. If we prepare early, then I think it is beneficial for our clients. And as comparatively this time the recommendations are many and in all subjects, like classifications there are recommendations, refunds there are so many recommendations, all sectors of GST there are some recommendations. It is GST 2, I think, right sir? It is not wrong if I say it is GST 2. They are starting new GST from this council meeting. I thank and request Aishwarya to please start.
So introducing CA Ravi Kumar Somani sir. I was actually privileged to meet him in person and attend his lecture on ITC credit years back, maybe in 2018 or 19, when GST was just born. And then that time was a statement on stairs of Pune ICI that I am just trying to simplify GST through my small efforts. And yes, honestly, over years, I've been attending your lectures through YouTube or seminars on Zoom or reading the articles you post on LinkedIn. And they've really been insightful to simplify the GST law. Ravi sir has authored various books on GST. He has written various articles, research papers, legal updates on indirect tax matters. And really, sir, we are glad to have you for this discussion today. Over to you, sir.
Thanks a lot, Aishwarya, for that nice introduction. Looking forward for today's session as well. I'm not sure to what extent it is in my hands to simplify GST, but then we try to just see what is that action that the businesses need to take in whatever complexities that are there. So that is what is our endeavor, Aishwarya. Yeah, over to you. You're on mute,
Aishwarya.
Sir, we are opening the platform for you to start the discussion.
No. Aishwarya, you introduce Abhay sir also.
Together?
Yeah. Both will start simultaneously. Yeah.
Okay, sir. So, welcoming a second speaker for the day, CA Abhay Desai sir, yet another dynamic personality. Like whenever we are CA students, we have some wish list ki rank chahiye, practice start karni hai, and everything is done by sir. He has got a rank. He started his practice right after the qualification. Sir has addressed more than 500 seminars till date. He has contributed in various articles, research papers. He has also authored books and has also made representations in front of the Honorable Finance Minister as well as the Deputy Finance Minister on various matters of taxation. He has been a member of Indirect Tax Committee of the ICI. So we're really eager to hear from both of you, sir. The platform is all yours.
Yes. Okay. So great. Thanks a lot, Aishwarya, for that introduction. And I'm privileged to be, speaking alongside Abhay, because Abhay is one of the dynamic speakers, as Aishwarya rightly mentioned. Most importantly, I sometimes think whether Abhay works 24 hours a day and 7 days a week, because the lightning speed at which he comes out with his updates. One is coming out with the updates and other is coming out with the updates which are insightful and have some more meaning. So I think Abhay, there's a tremendous contribution from your side, I must say, on this aspect. So what we decided is that today being a Sunday morning, and that too 3 hours long session. So if I would take for first 1.5 hours and Abhay would take, it would be only one-way communication. So what we thought to is that let's make this entire discussion interactive in a proper Jugalbandi style rather than, I would say, typical webinar. So what we would do is that Abhay and me, we will take up one by one point of the changes that have taken place in 47th recommendations. And then we will try to decipher what is it and the implications thereof. So before I go into the actual, presentation and all those things, I would ask Abhay to give his opening remarks and, some thoughts on 47th Council amendments that have happened.
Yeah, good morning. First and foremost, deeply grateful to Ravi for being kind enough. In fact, what he does is and what he says are at odds. Let me tell you why. Today morning when I got up, I saw a message at 5:30 from him saying that we need to discuss today's session. So that speaks volumes about his sincerity, his dedication. And in fact, I believe he works 24 hours, in fact, and credit to him, credit to the way he has developed the firm. It's heads off. Also thankful to the Pune branch, the vice chairman, Aishwarya ji, for being kind enough. In fact, getting a rank in CA, I believe, is a myth. Let me tell you, practically rank or no rank, it does not make a difference, because as today we'll witness, every day we need to learn things if we are in profession, and therefore really learning never stops. Now coming to the 47th meeting, certainly you can say it is almost like a budget, because the kind of amendments that they have proposed, certain notifications and circulars have already been issued that we'll discuss threadbare. Certain notifications are expected, certain circulars are also expected. The entire overhauling of GSTR 3B is what they are saying that they will put up in the public domain for comments, and probably we'll see a much bigger 3B, much more complex 3B as we go. More data probably would get captured in that return as time progresses. So yes, it will be an exciting session, and I believe the way Ravi has structured is certainly a better way to go through the amendments. So over to Ravi for initiating the discussion.
Yes. Thanks a lot, Abhay. So I hope my screen is visible. Rajesh,
yes, it's visible.
Okay, great. So what we would do is that we would take up one by one the topics. Abhay and me would alternatively lead the topics. So one topic I would start, and then next Abhay would start, and the next person would add, comments. So let's make it interactive. This is a flow what we have decided. Now, when we look at the various amendments, or I would recommendations of the GST Council, there are a lot of recommendations relating to the refunds, impacting directly or indirectly connected with the refunds. So all these aspects we will discuss first. And then there are a lot of amendments which are mainly to streamline the compliances. Of course, I'm not sure to what extent the compliances would really get streamlined, but it is intended to streamline the compliances. Those all bucket of amendments or recommendations we would take up next. Then there are a lot of sector specific amendments. Most importantly, these branded food products, which is a very big amendment. Then logistics sector, real estate, hotel, hospital, and other few miscellaneous changes. And in the end, we would take up the rate rationalization, because in multiple places, due to inversion of the taxes, the rates have been rationalized. So this is a flow that we will follow in today's discussion. First and foremost, very important amendment as far as the inverted rate structure is concerned, is in the context of refund of the input tax credit, more specifically towards input services. Now, we all know that VKC footsteps, there was Supreme Court judgment wherein the petition filed or the appeal filed was given in favor of the department, categorically specifying that there is no issue with the rule and the government has the power to provide for the rule, which is a comment of the Supreme Court. But then one very important aspect which was brought out in that judgment is that the formula is having its own limitation and aberrations in a way that while computing the net ITC, you are saying consider only inputs. Whereas in the formula, when we look at the subtraction part of it, the deduction part of it, it says that the tax paid on the inverted goods needs to be reduced. Now over there, it's a complete tax. It does not again restrict back to the input. So when the calculation, when what is coming into the formula is only restricted to inputs, then what that must go out of the formula must also be restricted to that extent. So to this particular point, which was pointed out before the Supreme Court categorically mentioned that yes, this is an aberration in the formula, and government must come out with proper mechanism of computation to make sure that this issue is not there. Now, first and foremost thing, as a individual, do I agree with this particular view of Supreme Court in VKC footsteps denying the refund in the context of input services? Personally, I would not agree with that view even now, despite reading the entire judgment, because I feel that section 54 is pretty clear over there, where the idea is to whatever is accumulated input tax credit, and that accumulation needs to be paid back to the assessee. And I don't see any reason for input services credit not be given. All I try to think, I don't find any logic behind this. But then even law, forget about the logic, even what stands as per law section 54, this needs to be there. Anyway, what was expected is that probably they would give the formula wherein even the credit on inputs input services would be coming. In fact, I would go one step beyond and say even capital goods needs to be done. But then the formula that has come is something like this, wherein in the net ITC, whatever net ITC is there, that net ITC needs to be taken only to the extent of inputs, not input services and capital goods. And on that net ITC, we need to apply the turnover of inverted rate structure divided by the total turnover, that's the adjusted total turnover. And from there, we need to remove the tax that has been paid on the inverted rated supplies. Now, if I can explain this with an example, let us say the total credit for an assessee is 100 rupees, 60 being inputs and 40 being input services. And as far as the turnover is concerned, let's say total turnover is 1500, where 500 is on account of turnover of inverted rate structure and 1000 not being on the non-inverted. So inverted rate turnover is kind of 1/3, right? So basically on 60 rupees itself, the credit continues to be 60 rupees. It cannot be 100 rupees. And on 60, current formula, the way it was there, on 60, it was 500 divided by 1500. It's 1/3 of 60 comes to 20. And out of that, whatever is the tax that paid on the complete turnover was subtracted rather than only on the inverted structure. So now, if you see the existing formula, the refund actually comes negative, -5. Now, when we apply the new formula, where what is to be subtracted must also be rationalized and to the tune and proportion of the inputs itself. So in that case, that 25 would become 15, because again, 60 divided by 100 to the extent of inputs. And we see that the refund becoming positive. So certainly this is going to have an advantage. This is going to increase the refunds for all the businesses who have inversion in their supplies. Now, the important question that comes is whether this amendment is prospective or retrospective. There are a lot of questions coming in. What about the new applications that I'm going to file now? How about the applications that have already been filed but not yet sanctioned? And multiple aspects. So in my view, this particular amendment has to be read retrospectively. right from 1st of July 2017. Reason being, this is an aberration in the law. This is a correction of a mistake. This is a correction of an error which was there inbuilt in the law. And we have settled jurisprudence that once there is a correction in the law or correction in the mistake, it has to be read retrospectively, because that is what it was intended. And nobody can deny that it was an error, because this is what Supreme Court pointed out in VKC footstep, that it's an aberration in the formula. So in my view, this has to be read retrospectively. An important action point that comes out is that businesses needs to file an application for refund for the balance, whatever that is there. Only biggest problem that's there is today, again, I don't see any mechanism to claim refund. Ultimately, businesses would have to possibly go under others category and file the refund application. But again, over there are a lot of issues being faced at the ground level. So all in all, I would say this is a welcome amendment. I'm very happy that government has quickly, worked on the judgment of Supreme Court's recommendations. But then, yes, I still feel there's still gaps over there which are not addressed. So I would ask Abhay to share his comments on this particular amendment.
Right. So basically, as rightly pointed out, in fact, Supreme Court in VKC made an observation saying that if you look at the provisions of the Act, it permits refund of an accumulated credit on inputs. And when you go to the rules, the formula is structured in a way to say that whatever the tax you are paying on the inverted rate turnover, that has to be assumed to have been paid exclusively from the credits attributable to inputs. And therefore, the Supreme Court observed that that cannot be the case, because certainly these credits go into a common basket. And when a taxpayer is utilizing those credits, certainly the tax that is payable on the inverted rate turnover, part of it stands paid or would have stand paid from the credit that is in respect of services or in fact even capital goods. Supreme Court in that particular judgment also observed that, look, whether we apply a FIFO basis to say that, let us say in this example itself, this 25 rupees that is payable, can a position be taken to say that first entire credit of inputs services is utilized, that is 40 to pay that 25. And therefore, at the end of the day, to say that whatever has accumulated is exclusively on account of inputs, and therefore the entire 1/3 of 60, that is 20 rupees, should be refunded. That was also one of the view that was observed by the Supreme Court, saying that this is also tenable in a certain situation, because as we will see again, when we go to the interest-related amendment, in fact, as far as the wrong credits are claimed, the law is supporting that view by saying that whatever you utilize first will assume to be legitimate credit, and whatever remains balance would be the illegitimate credit. And only when that gets exhausted, it is at that point in time that it would be considered to have been utilized. So interest liability would accrue from that point in time and not from the earlier point in time. So that basically, again, in a way supports a view that the manner of utilization, since law is silent, certainly a taxpayer should have been permitted to determine. And based on that, in such situation, a taxpayer would have certainly used first credit on input services to pay off the liability, and therefore the amount of credit that one would have accumulated on inputs would have been significantly higher. But having said that, the council did not appreciate this aspect, and they went on a pro rata basis, assuming that since all are getting into a common basket, we'll assume, as in this example illustrates, that since 1/3 is my inverted rated turnover, so we'll assume that 1/3 of the total credit of 60, that is 20, is going into utilization of payment of tax of 25. And on that basis, the net ITC, the tax payable, is reworked. Now, having said that, I believe that argument now cannot be made to say that we'll consider a FIFO basis or any alternate basis, because the formula, the way they have amended, does not leave room for that argument, so to say. On the part of whether this amendment is a retrospective amendment, I would say that when you look at notification, that is 14/22, this amendment has been brought through para 8 of this notification. Now, that language that they are using to make this change is to say that under existing rule 89.5, this last portion that you can see in the slide that has been, that is part of the existing formula that has been crossed, that would be substituted with the new part that you see in the second pair of the slide. Now, the word substitution is something that has to be interpreted. Courts have held in the past that a substitution means a replacement of existing provision with a new provision. Now, whether that replacement would apply with a current date or with a future date or with a retrospective date depends on the context in which that replacement has been undertaken. Now, in this context, clearly the law, the way Supreme Court has read it, says that only credit accumulated on inputs is eligible. To determine that amount, certainly a reasonable formula was required, and that is now coming into the law. So I would say that the way in which the context has developed, this is certainly an error that council made when they formulated the rule. In fact, if you see the history of Rule 89.5, in fact, initially they allowed services refund also. Then they made an amendment in 18 saying that no services will not be allowed because someone told them that, look, under the Act, this view is plausible, that only on inputs we can grant the refunds. So some bureaucrat maybe hinted the government. So government, as always, whenever there is a case where they can hold the refunds, those ideas are, government is all open to those ideas. So government readily accepted that idea. In 2018, made a retrospective amendment to 89.5 to bring this change. Now that retrospective amendment also suggests the context that was made because from day one, the parliament intended only to grant refund of the credit accumulated to the extent of inputs. So if that can be done retrospectively, certainly this also is nothing but a further correction to that formula that was already done in 2018, and it should also apply in that context retrospectively. So that is number two. Number three, I would say that those taxpayers who probably would have filed the refund claims falling under the inverted rate structure might have done it under the existing formula, ignoring the tax payable component that out of the ITC related to services. What remedy is available? I would say that yes, you can file the refund claim. Section 54(1) does not prohibit multiple refund claims for the same tax period. On the GSTN portal, as Ravi rightly said, under the others category, you can make a claim. You can also consider another amendment that we'll discuss at later point in time, whereby the COVID period, so to say, from 1st of March of 2020 to 28th of March of 2022 stands excluded for the purpose of computing the limitation of 2 years under 54(1). So by taking recourse to that, probably you will be able to go back even beyond, much beyond 2000, much before 2020 also, and make a claim. Now, why this is important? Because look, there are certain taxpayers who are having, in this particular case, only 1/3 turnover is under inverted rate, but there are a lot of taxpayers who are having a major part of the turnover under the inverted rate, and they do not foresee any possibility also of encashing that credit as time progresses, unless of course the government makes those goods taxable at a higher rate. So in that situation, it becomes inevitable that the only remedy that this such kind of taxpayers have is to make the refund claims even of the past period by considering the revised formula and pursue those claims. So that would be from my end. I would have been happy to consider if two aspects would have been addressed. One is capital goods credit, because on that aspect also, let us say in this particular month, apart from this 100 rupees of credit, let us say there is a 50 rupee of additional credit in respect of capital goods. Now, entire 150 goes into a credit ledger. To say that 50 remains untouched and will always permanently remain untouched, again, something goes against the principle of putting the credit into a common block and then permitting the usage of that credit for discharge of tax. So I believe those capital good issue again can get litigated. In fact, when the matter was argued in the Supreme Court, that capital good aspect was not canvassed. In fact, only the service input and input service was the issue before the court, because it is only in that context that Gujarat High Court had given a ruling. In fact, there are petitions pending in respect of the capital goods before the Gujarat High Court as we speak. So perhaps there again, Supreme Court may in a similar fashion intervene. and probably we'll see another amendment, maybe incorporating that capital goods aspect also. But if you are having that significant amount, probably you can keep the claim alive by filing the refund application. So that would be it, I believe, on this issue.
Yes, fantastic coverage, Abhay, on this aspect. So now,
Ravi sir, I believe still it is an injustice to give formula instead of straight giving full refund of the balance accumulated credit.
absolutely, sir. And that is what, Abhay has mentioned, I mentioned in the start itself, that while this is not the, complete thing, many people, when this recommendation came, started having understanding that now input service ka credit milega, but this is not the case. It is still a limitation in the credit that's been granted, but a little bit more than, not give, I would say. Yeah. So we'll move on to the next discussion. Abhay, you can take this up on the concessional rate. Yeah.
So this again is an issue that basically it's a circular which is overriding another circular that has been issued. Basically, let me tell you the case. It happens that, let us say, there is a taxpayer who purchases certain instruments. He's a normal trader, so he purchases those instruments at full GST rate of 18%. He makes a supply of those instruments to certain research labs which are funded through public grants, and there is a concessional rate notification to say that that supply would attract GST at 5%. So it is the same product. Inward supply is at 18%. At the same point in time, he is also making an outward supply of those very goods at 5%. So again, this is a case where there is an inverted rate, and therefore under section 54.3, the refund should have been eligible. 54.3 does not distinguish between whether the supply under the inverted rate is of the very goods for which you are claiming the refund of the accumulated credit, or some other goods manufactured out of the inputs that you have received. But nevertheless, in fact, the circular that was issued earlier, that is 135, took a view that no, if those are same goods, will not allow the refund. Again, there are two decisions, as one already pointed out in the presentation of Guwahati High Court. There is another decision of Calcutta High Court where the courts took a view that no, this is wrong. The circular is contrary to the law, and therefore, even in such situation where those same goods are further supplied, as long as your rate on inward supply is higher than the rate on outward supplies, you should be eligible for the refund of the accumulated credits. So now the board has accepted the wisdom of those decisions, and they have amended those earlier circular 135 by bringing a new circular 173 by changing the relevant para to say that the refund would be eligible even if there is a further supply of the same goods attracting different GST rates because of the concessional notifications, and therefore in the given example the refund should be eligible. Since this is a circular, certainly there is no question of this being prospective or retrospective. From day one it applies. It's merely a clarification. So even right from July 17, this view will prevail. Circular also indicates that if at the same point in time, if at a different point in time the same goods are supplied, because of the rate change done by GST Council, now that we'll see that as a rarity now, where GST Council will be reducing the rates. In fact, we'll see the reverse trend more and more as time progresses. But take a case, hypothetical case, where currently your goods attract 18%, you are having certain stock with you, and tomorrow the rate stands reduced to 12 or 5. And when you supply that goods, certainly you will have to charge 12 or 5. Again, there can be a case of accumulated credits on account of that fact. So in that situation, whether refund is eligible, in my opinion, still under section 54.3, refund should be eligible. Circular 135 said no. That aspect has been retained even by circular 173 to say that if this is the case where not because of any concessional notification, there is a general rate reduction of those goods which you have supplied, because there is a difference in a point in time where today when you acquired it, the rate was 18%, and when you supply it, there is a different point in time, the rate stands reduced to 12%. In that situation, the refund would still get restricted, the refund would still not be available. Now, that is again something that probably I think the board is waiting for 2-3 more High Court decisions to enlighten them. And probably perhaps we'll see again this circular 135 probably getting revisited. So, but as on date, at least for those assessees who are having a supply where at the same point in time their inward attracts higher rate and outward attracts a lower rate because of a concessional rate notification, those assessees would now, in fact, would not face issues when they file the refund claims because the circulars are normally read only by the board, by the department, and that is right. Also, as a taxpayer, we need not concern ourselves much with the circulars. But anyway, now those irritants would not be there for those assessees. So I think that would be Raviji, if you want to add.
I completely agree with what Abhay mentioned. In fact, I really don't understand when they give circular. Circular is to clarify, but then with one clarification also comes one confusion. That is a biggest problem. So when I was also reading the same circular, I thought it's a good circular only in the brackets with 3 words at the same point. So that was there where they created confusion, which means, let's say same goods, there's a mobile phone which was at 18 and later it became 12. Ideally, it leads to inversion. But I really don't see a logic. When I read the act, it's very clear that the refund must be eligible on that as well. But again, they kind of emphasize that it would not be eligible on that. But I am of strong view that they need few more judgments of the High Courts to come out with that aspect as well. And that's clarification that has come, actually speaking, it's not needed because that was a confusion created in the earlier circular, which has been clarified. So there's nothing, I would say, great benefit out of this. But yes, nevertheless, at least ground level issues would not be there to this extent. So, yeah.
I think one more circular is required to clarify this circular.
Yes, correct. So that is the unfortunate thing. Okay. So next amendment, again, I would say very, very important amendment. So we all know that when we file, there are 2 aspects of making an application for refund. One is with payment of IGST and another is without payment of IGST under LUT. So with payment of IGST, when the GST law got introduced, the idea or the thought process was, you just need your GSTR 3 would be considered as good as a refund application. And in 7 days, you will get the money. And all this, important things were told. And business was very happy that yes, up to refund, seedha bank account mein aayega. And of course, then came all these issues. We all know mismatch between shipping bill data and GSTR 1, leading to a lot of refund applications getting stuck. So now we know that in case of export of goods, when it is with payment of IGST, it's automated system where the money straight away comes to the bank account. When it's without payment of IGST, it has to go through the jurisdictional officer. This is something government is not happy with. With payment mein itna easily kaise mil raha hai refund. Okay. So now this particular amendment, it says that if the commissioner in the board or authorized by the board, officer authorized by the board, based on the data is of the opinion of the risk, considering the risk parameters and various credentials of the exporter, that this is a risky exporter, then those exporters, the refund would not come automatically. It would rather be converted into an application of refund RFD01 electronically by the system. And that electronic RFD01 will be communicated to the jurisdictional officer as well as the exporter. And the exporter would have to undergo the same rigors of refund as it is for without payment of IGST. In a nutshell, if a particular assessee is identified as a risky exporter, then he would not be getting the refund straight into the bank account. It would be going through the rigors of the departmental officer. So this is the amendment which has been there. Now, there are few aspects which I would like to bring out as far as this amendment is concerned. First and foremost, when I look at the provisions of the Act, it talks about provisional refund of 90% to be granted without getting into the verification of accounts, records, document. That is the provision which is there. Now, other aspect which is there is that this is, if you ask me, it's more of withholding the refund. And we have already seen a few associates who've been tagged as a risky exporter by DGARM. It took a pain of 1 year running from pillar to post to remove that tag. So now what is this parameters going to be? How they are going to identify, and on what basis the opinion is to be derived that these are the exporters who are fraudulent exporters or whatsoever, and they need to go through complete verification. It's still not clear. But what I understand is that most likely it's DGARM who would be doing this particular exercise. So we need to be ready that refunds are now going to become more tighter, even those refunds which are with payment of IGST. And strictly speaking, I feel this particular amendment is not in line with the provisions of Section 54, where in this context, it has been made out that the application for refund was whatever GSTR 333 that's been filed is as good as an application. But now again, this modality is going to create a problem. Of course, one thing what they say is that the day on which this RFD01 is being generated, system generated RFD01 would be there. That would be considered as a date of filing an application for refund for the purpose of time limits. And all the provisions of Rule 89 that are there for without payment of IGST refunds would be applicable in this case. So all in all, I see that this amendment is going to create a bit more turmoil for businesses hitherto who were claiming the refunds and getting the refunds smoothly for with payment, and certainly going to lead more harassment. So over to Abhay for his comments on this amendment.
All right. See, first and foremost, there are basically two set of amendments that we need to understand here. One is an amendment under Rule 96 of the CGST rule, that is 96 sub Rule 1. Now, what it says, basically it says that when a person makes an export with payment of IGST, the shipping bill that he is filing would be deemed to be the refund application. And therefore, today when you are, let us say, filing a shipping bill, when you are making an export with payment of IGST and claiming a refund of that amount, in that situation, today is the date on which it would be considered that you have filed the refund claim. Then the sub Rule 1 says that that claim would be considered to have been filed in a situation where the person has furnished a valid GSTR 3B. So that was a condition attached saying that mere filing of shipping bill would not be enough. You also need to file 3B. And moment you file 3B, the claim would have been considered to have been lodged. Then the law mandated under 96(3) that that claim had to be decided by the customs authorities. And if there is a delay, then the taxpayers were seeking interest, and certain high courts have passed the ruling granting interest on account of such delays. Now, what is the case? The case is today, let us say you are filing a shipping bill. Shipping bill is correct, but when you file the return under in terms of statement in terms of GSTR 1 and return in terms of GSTR 3B, there is some error that you commit. Now, the way the law is and the way the system is designed, there is no way you can immediately seek a remedy for that error. There is a procedure. There are several circulars issued where you have to physically go to the port. You have to explain your case. Then the officer, if at all, is satisfied, he would make an entry, make corrections, and then the refund would go for processing. So it may take 2 months, 3 months, 6 months to get that matters resolved. Now, in that situation, the refund would not get remitted. So the taxpayers were seeking refund, right, along with interest. And high courts agreed that, yes, look, this is your mistake. You should have created a facility for an early rectification. If you yourself have not created the facilities for enabling early rectification, then taxpayer cannot be blamed for that. And therefore, taxpayer is entitled to interest if there is a delay in remitting that amount. Now, what this notification is doing, interestingly, it is amending Rule 96(1) with a retrospective effect from 1st July 2017. Now, what is the amendment? The amendment says that just filing 3B would not be enough to say that you have filed the refund claim. A clause is added to that sub-rule 1 to say that if there is a mismatch between your data and the customs data, in that situation, it is only on the date on which you rectify that mismatch that it will be deemed that refund application has been filed. And this is a retrospective amendment because this is something that they never wanted to give interest on. And therefore, what they are now saying that today, if you make a shipping bill, file a shipping bill, there is some error in the shipping bill, there is some error in your GSTR 1. And because of that, the refunds do not match, the amounts do not match, and therefore those refunds remain stuck. And it is only after a certain period of time that you can rectify those errors. It is only at that point in time that it would be considered that you have made the refund claim. And therefore, it is from that point in time that the time limit to grant that refund would start. And if those refunds are then granted within the time limit, then no interest would be payable to that claimant. So this in a nutshell is an amendment. This is basically to override certain decisions of the high courts where they have said that, look, under 96(1), you have never mandated mismatch as a criteria to delay the deemed date of filing of the refund claim. So to override that proposition, this amendment has been made. Again, something not welcome, because as I said, taxpayer might have committed an initial error, but then if the system does not give him the remedy to rectify that error, and then if the proper officer at the customs takes their own sweet will to rectify those errors in the shipping bills, and only thereafter the claims would get processed. And if they are taking 6 months time, 1 year time to undertake those activities, certainly a taxpayer should be entitled for the interest in that situation. But now, because of this amendment, it is only when it is rectified. Remember, this rectification at most of the time is to be done by the customs officers, because if there is a problem in the shipping bill, as an exporter, you don't have any right to rectify that shipping bill unilaterally. It is by following the procedure under the Customs Act under 149. It is only by that route that you can make those rectifications. So something I again believe is not in line with the ease of doing business, because you cannot blame the taxpayer and deny the interest to that taxpayer on the ground that your officers are making a delay in making those rectifications. So that is number one. Number two, now what happens in a situation where the DGRM says that this fellow is a risky exporter. Now, why is a risky exporter? Because under their algorithm, somewhere they find that this is taking some fake credits, some wrong credits, maybe not his supplier, L1, L2, L3, L4, L5, God knows how far they will go. But let us say in the chain of transaction, it is your fourth sub-vendor who has taken some fake credit, who has given to L3, L3 has given to L2, L2 has given to L1, and then L1 has given to you. Because that error was committed by L4, you are a risky exporter, and therefore we are blocking all your refund claims of IGST paid on exports. Now, that was the power that they used to exercise. There was no power in the act or the rule which permitted the authorities to exercise that power. But in the IceGate portal itself, they used to put a block, and therefore the system itself would not generate the scroll as far as those registration, those risky exporters are concerned, and therefore those claims would never get processed. And then again, they used to take their own sweet will to make the investigation. It may take, in one of the case what we had handled, it took more than 1 year for the, we in fact said that, look, problem is with L4. We are ready to pay his liability because that was only 2-3 lakhs, but our 80 crore of refund was stuck because of that 2-3 lakh fake credit that maybe L4 has taken. So we met the commissioner. We said, look, we will pay 2 lakhs with interest, penalty, everything that you want to collect from L4. At least clear us from risky exporter, and then only, because otherwise customs will not process our claims. But they said, no, look at our circular. We have to ask each commissionerate wherever your L1, L2, L3, L4 are there, unless they give my commissioner a certificate saying that yes, we have verified and they are clean, then only my commissioner will give a clean certificate to DGRM, and then DGRM at their sweet will decide when to remove the tag, and it is only from that point in time that the refunds will start getting processed. Certainly something which exporters were not happy. Again, number of high courts stepped in. They stepped in by fixing certain mandatory timelines within which this inquiry has to be completed, and so on and so forth. But there was no power in the rule which allowed them to withhold such refunds. If you look at Rule 96(4), before the amendment, withholding was possible only in two situations. One is where the jurisdictional commissioner is saying that some dues are payable for that person, against that person, or certain dues could arise against that person, and they apprehend that by the time those dues may arise, this person may not be may defraud. And if that is the intent of that person to defraud, in that situation, the commissioner may suggest to the customs authorities that, sir, kindly withhold these refunds because we have this apprehension. That is first situation. Second situation was where a person undertakes some violation under the customs law. In that situation, again, the power was given by the rule to withhold the refunds. So nowhere this rule allowed withholding of the refunds on account of liability of my vendors or my sub-vendors. That was clearly not what was permitted by way of Rule 96.4. Now what they are doing, they are again making this an amendment to 96.4, again a retrospective amendment to rectify their error by inserting a new clause C to this 96.4 to say that now based on data analysis and risk parameters, if we find that the availment of ITC by such exporter is erroneous, in that situation, to safeguard the interest of revenue, this exporter's refund would also be withheld. Again, the language used deals with ITC of the exporter, not the ITC of the vendors of that exporter. Now, having said that, what they are now saying in a way to give solace to the industry, that look, withholding will continue. We will not stop withholding. Whenever our risk parameters indicate that you are fishy, we will withhold. But now, instead of withholding and sitting and waiting for the commissioner to report to DGRM that yes, you are given a clean sheet and then the tag would get removed, what we will do, we will throw this refund application to the jurisdictional officer. So by way of an RFD 01, this refund claim that was made by way of a shipping bill would get converted into a refund application made by RFD 01. The process would be automated. Of course, for the time being, they are also saying that till that automation does not happen, you have to manually again file RFD 01. But when it will be automated, this claim of that shipping bill would get converted into a separate refund application, qua that shipping bill, by way of an RFD 01, and it would go to that jurisdictional office. And then they are saying you apply all the safeguards and everything, so and so. Now, let me tell you that if DGRM is sensitizing the officers, saying that this is a risky exporter, do you think a subordinate officer who will be dealing with this refund claim would be bold enough to say that, look, DGRM may say whatever they may want to say, whatever analysis they may want to do, I will give you a clean sheet and I will process this RFD 01 application and I will grant you the refund. Now, this is a totally, in my opinion, humbug. Officer will again use the same power under Rule 96.4 and say that, look, even against this refund application, since I believe your credits are not genuine, I am going to grant that refund, but I am going to again withhold that refund under 96.4. That is what DGRM also wanted to do. And now that they were doing it directly in the customs portal by stopping the claim itself. Now I will be doing it by allowing the claim and then withholding that claim. So I don't see this as a positive amendment in a say that unless they streamline the process of verification of these risky exporters by bringing a definite timeline of 10 days, 15 days at the most, and giving the information. Right now, the practical problem is the exporters come to know from their CHA agents that, sir, aapka tag lag gaya. No information is there in the customs portal that what is that risk parameter that got triggered. What was that ITC that they find ineligible, so that I can at least reply with those facts. Right now, these exporters then wait for the DGRM to send an email ID to the jurisdictional office. In that email ID also, the DGRM does not mention what is the risky parameter. They only say this is a risky exporter, you verify. Now, in that process, what the jurisdictional office does, they undertake a thorough audit of the exporter. And only thereafter, they give a clean sheet, a kind of an NOC by way of an email to DGRM. Only thereafter, this tag gets removed. Now, that process needs to be streamlined urgently. This is not the way you can carry that process. You need to indicate specifically which credit you are saying it is risky. If it is not my credit, then certainly this rule does not apply to me. You have to go and catch that vendor or sub-vendor who might have availed that fake credit or whatever is the ineligible credit. And second, once that is indicated and once a reply is given by that exporter, you need to make sure that your officer within 5 days examine that reply and submit a report to DGRM to remove that tag, because automatic processing happens in few days of refund claim. This manual processing and then again exercising the power to withhold will probably not solve the purpose which is sought to be aimed at. So that would be my comments. I don't see this as a positive amendment, both 96.1 amendment and 96(4) amendment, both are in fact retrospective so as to correct their errors. That is again something which is highly not desirable, and therefore I would say that this is something that should be again relooked by the council in the light of what we discussed.
Agreed. In fact, we should just pray that none of our clients tagged as risky exporter. It is such a pain for one of our clients. The MD has to literally go before and go to the commissioner for 3 to 4 times. And this is what if the MD is going to do. And I'm not sure whether MD must run the business or do all these activities. And
Absolutely.
again, it took 1 year for us to remove that risky exporter, calling his vendors. Very unfortunate. So now what was there in circular has come as a part of a rule, giving, I would say, more authority for the officer to do this more often. Of course, next amendment, Abhay, in the context of this PMT 03A, if you can just touch upon.
Right. See, basically, in fact, there is a corresponding amendment in the Act itself. So first, let me rule itself. So first, let me deal with that amendment. Right. So what basically they are saying, in fact, see, there is a situation. First, we need to understand that, and then contextually understand the amendment. See, there are situations where persons have claim refunds which are ineligible on payment of IGST. So look, like for example, if you are making an export with payment of IGST, and simultaneously you have taken an IGST exemption on imports under advance authorization, then Rule 9610 says that, look, you are not eligible for the refund claim. So that is one situation. There is a situation where even you could have claimed refund of unutilized ITC without payment of tax, and ultimately even that refund gets rejected or allowed and then ultimately recalled. Now, in all these situations, what happens to that ITC that was utilized? Because on one hand, the taxpayer may agree to return that cash that he received against that refund claim, if that refund claim has been allowed. If the refund claim is not allowed, then there is no question of any recredit, because that credit remains, that claim remains alive, and that claim has to be then pursued. If the claim has been allowed, because in an automated system, especially in that 9610 scenario that we discussed, where person is claiming the refund of IGST paid on exports and claiming the benefit of exemption on imports under advance license. In that situation, subsequently, the department identifies the breach. Taxpayers may voluntarily also in certain situations may identify these violations, and they may want to rectify that. Now, when they want to rectify that, they are willing to pay that refund back to the authority. So they may use DRC 03 as a form to return the cash refund that they received along with interest. Now, what happens to the credit that was utilized in discharging the tax? Certainly, a government cannot enrich twice by, on one hand, recovering the refund and denying the credit also. Recredit of that credit also that was earlier utilized in payment of that amount that was earlier received as a refund. In fact, in excise law, that law I would consider to be much more, I would say, mature, because in that context, in Rule 18, if you see under the central excise rules, if a rebate claim was ultimately rejected, there was a categorical provision to return the sunward credit that was utilized in making that payment of that amount of the claim that was rejected. Here in this law, we did not see that at all. Now they are bringing that by saying that, look, we will allow the recredit of that amount of credit that you have utilized in paying that amount and claiming that refund that now you are returning back. Now, how that will happen, that is where this comes into play, the PMT 03A. This is a form that they have designed. Basically, it is to be done by the officer. An application has to be filed by the taxpayer by way of a letter saying that, look, I have paid this amount, attach the DRC 03 as a proof of payment of that refund, return of that refund, and based on that, the officer would pass this order and return that credit back to your credit ledger. Timelines are again not, again, this is not desirable, but something that they are saying that within a period of 30 days, preferably the officer should pass. Now, why there is a preference here? I don't see any preference. It's a simple plain vanilla case. If I have returned the refund, you need to recredit that back amount into my credit ledger. But anyway, preferably is there. So if there is a 30 days is what they should endeavor, but if even if it goes beyond 30 days, you will not have any significant remedy for that action. Having said that, now here there are certain issues that remains to be unaddressed. In fact, yesterday only one of the client called up saying that, look, this has come now. Now in that situation, what had happened that he had paid, let us say, 100 rupees of IGST on exports. I mean, that month he had only, that was only a single invoice. In that month, he had only credit of 90. So what he did, he utilized 90 and he paid cash of 10, and that is how he made the payment of 100. And that 100 was refunded to him. But he had also claimed the exemption on imports under advance license. So legally, he was not entitled for that refund claim of 100. So he said, look, now by way of this amendment, 90 will come back into my credit ledger. But what happens to the 10 that was debited in my cash ledger? Whether the 10 would also come back into my cash ledger? Answer is no, because this notification only provides a remedy for crediting the 90 back to your credit ledger. For 10, there is no answer that 10, whether 10 should also come back, and if yes, in what manner the 10 should again come back, because that entire 100 first has to be returned. Because remember, the 10 that you paid for discharging that 100 are two separate events. 100 is the refund claim that you made in violation of Rule 9610. So that has to be entirely paid back. And then whatever that was used for making payment of that 100 requires to be restored back, either in the credit ledger or in the cash ledger. This talks only about restoring it to the extent of credit, not about restoring the cash aspect. So that is something that has to be addressed. Second interesting issue is this, that what happens to, see, look, 90 may come back to me. Now those exports are to be considered as made under LUT technically, because once I'm returning back 100 to the government, those exports are not made without payment of, are made actually without payment of IGST. So the second query that he asked me is that whether now I can claim the refund under Rule 89.4 or 89.4A or 4B as the case may be. Because in that situation, he is entitled for the refund. Originally also, if you would have done those exports under LUT, he would have been entitled for a certain refund of the accumulated credit against that exports, because legally exports are zero rated supply. So the policy is not to restrict refund of whatever credits that has been accumulated qua those transactions. Now again, notification does not address that issue. Notification does not say that, look, we will consider now those exports as under LUT. There will be a technical problem by the department saying that, look, when you exported it, it was with payment. So at that point in time, no credit refund eligible. Now, even if you are returning back, we will not consider this to be export under LUT, because where was the LUT number mentioned in the invoice? In the invoice, actually, you had in fact charged GST. You had filed the shipping bill, indicated GST on that shipping bill. So we'll reject even the claim under 89 as far as that is concerned. So there is again second issue, a follow-up issue that will arise. Third issue. See here, basically this is one remedy. Please consider this not as the only remedy. In a situation that we discuss under violation of Rule 9610, there is a remedy available under the customs law also, where you can go back, get your bill of entries amended under section 149, surrender the IGST exemption that you had earlier claimed under advance authorization, regularize the refund in that manner by saying that, look, now I have not violated Rule 9610, and therefore the refund 100, whatever I have claimed, is legitimate. By doing that, you will save significant money, because please understand the IGST amount on your inputs for which you would have availed the exemption ordinarily would be lower than the IGST amount on exports on which you would have claimed the refund, because the export value would include a lot of other cost, profit margin, lot of other aspects on which 18% would have been calculated. So that is to be understood and kept in mind. In fact, Gujarat High Court has already held that option is always available to an exporter even at a later point in time. Second reason for this is that interest rate under the customs law is 15%, whereas interest rate, if you return back the refund, is 18%. So there again, there is a saving if you return back the IGST on imports. Third, if you look at the language, in fact, in this situation, the language should have been that only pay refund amount and interest, The language says penalty wherever applicable. Now that is disturbing. Now look, this is only a case where credit is not in question. Only the mode of taking the refund of that credit in question. The government is not saying that you have availed illegitimate credit or erroneous credit. Only the mode through which you avail that refund was against the law. So in this situation, ideally the word penalty should not have come by way of putting it as a part of notification. Let the authorities decide as when they want to pursue the case, whatever is the situation. Whether this is a case under 73, 74, how they want to deal with those aspects. How can a notification preempt that action and suggest as a part of the notification that look, when you pay it with interest and penalty wherever applicable. Now, wherever applicable would mean penalty is automatic. That is the view coming out from the board saying that look, penalty is just like interest. It is like automatic only. So wherever applicable, you pay. Penalty can never be automatic. There is no question of applicable, inapplicable. Penalty is always contextual. And that requires a proceeding to be initiated to recover that penalty under 74. So that again, something that I believe that penalty would just complicate the matter because 100 someone may be willing to pay. Interest on that 100 someone may be willing to pay. Now saying penalty also you will have to pay. And then only we will recredit that amount by PMT 03A is something that will again start a new set of litigation where you would argue that look, penalty is not payable. The officer would say, look, penalty is payable and therefore unless you pay and show me DRC 03, I will not pass PMT 03A and grant the recredit of that amount. So again, something which will keep that exporter in dark. So again, something not desirable and something has to be relooked. So I believe that is what would be my stand on this amendment.
Correct. No, very detailed, Abhay on this particular aspect. I would rather say only two things. One is I see this entire amendment as an eyewash for a simple reason is that they could have, if they really wanted to make it simple, they could have totally automated this entire mechanism, which is not the case as of now, at least. So there's no automated functionality. And one has to ultimately go for a manual return request. That is what it says, manual return request. These are wordings.
Right.
And as you rightly mentioned, it has to again go through the jurisdictional officer. And most importantly, the jurisdictional officer should pass an order again verifying all the things once again, which was already done in the past and it's been declared to be erroneous. Now the money has to come. That's very clear. But again, he's going to verify all the things and preferably within 30 days. Now that word preferably, I don't understand why that comes in, again, preferably within 30 days. And I totally agree that this entire thing came only because of this rule 9610, where I would say in bulk, they have issued these notices asking to repay and recredit. A lot of taxpayers paid back with interest. I have my own reservations on 9610 because when I read that rule 9610, they use certain notification numbers over there, notification number 78, 79 of customs and a few more other notifications. When I actually go and read those notifications, the effect of that notification is not there after 31st March 2018. In fact, that 78, 79, when you read the notification after 31st March 2018, it's no more effective. They have come up with a different notification altogether, not amending 78 and 79, but that corresponding amendment is not there in Rule 9610. So that is very important aspect we need to understand. In my view, Rule 9610 does not apply at all. And I would go one step forward and say that, interest itself, for me, it's a pain to ask a client to pay that interest also. So, of course, but this amendment is not just in the context of 9610, various other aspects where also the associates paid the extra tax. They can go for this. I would say if this is creating a pain, because see, what is PMT 03 or 3A, and they may come with 3B, 3C, all these things, just a vehicle to get the money back in your electronic credit ledger. And in my view, if there is a problem coming in this, it's a good way to claim the credit directly through GST or 3B rather than they should have done that. In fact, now in the coming amendment, even GST or 3B, they're going to bifurcate the credits between what is for this month and earlier, so that all the other issues also go off. They should have done simply that. But then again, I don't know why, what is the fun in having all this number of forms? I don't even remember now.
Yeah, please.
Yes, yes, that's all. That's all I had to say,
Okay.
Abhay.
So see here, one more remedy is available since you are saying. In fact, there was a similar controversy even in the context of excise, where people were claiming this dual benefits. On one hand, exemption on inputs, and on the other hand, claiming a rebate claim on exports. Now, in that situation, we have a Gujarat High Court decision where they examined this aspect threadbare. And what they say that, look, what is the problem of the department? That they don't want a double benefit. That is the entire issue of the department. So in fact, in that decision, that exporter could demonstrate that, look, even otherwise we were eligible for that amount of refund. So in that situation, the High Court said, now then where is the question of you invoking this rule and denying and recovering that refund? So I think that can be, because in many cases we have seen that even if you would have, let us say, considered those exports as done under LUT and then worked your refund amount, probably you would get a substantial refund claim even through that route. So the question would be only limited to any additional amount that perhaps under Rule 96 stand you could have claimed. So interest liability should basically, if at all accrue, it should accrue only on that amount, not on the entire amount. So again, that is something that one must keep in mind while dealing with this issue.
Correct, correct. So it's a revenue neutrality aspect which Abhay is bringing up. Coming to next amendment in the context of supplies made to SEZ. So when the supplies are made to SEZ, it has to be under the declaration, or I would say, there has to be endorsement by the specified officer in the SEZ. So the word was specified officer. So there was question, what do you mean by specified officer? Can SEZ specify any officer to be a specified officer? For this purpose, this is the specified officer. There was a lot of confusion on this aspect. So I think this is more of a clarificatory amendment where they have mentioned that specified officer means, the authorized officer, whatever the SEZ Act, whomsoever is, it's deemed to be that person only a specified officer. So I would not have much to add here. Abhay, anything else?
No, nothing. It's just a clerical amendment.
Yes, yes. Okay. So we'll go to the next amendment. Okay. Again, very important. Abhay, you would like to take this up?
You can take it up, no problem.
Yeah. Okay. So this duty-free shops at the airport, again, I would say this has gone through a lot of rigors, unnecessary amendments, changes that has happened. We all know that duty-free shops in the airport are after the, this immigration counters. Obviously, whatever a person purchases from duty-free shops, eventually it goes outside India. It gets exported outside India, especially the international, immigrations. But then government was not happy. I don't know what is the reason, but in 2019, they came out with a rule 95A. Then there is circular 106, wherein it was the entire thing was not considered to be an exempt and rather export. Rather, it was considered to be a kind of a special case of benefit that is to be given, and only on the inputs portion, the refund was granted, rather than on input services and of course capital goods anyway not there. So on the input service, but again, even for duty-free shop, there's substantial amount of capital goods also, and I would say input services also that is there, which should have been granted as a refund. Rather, they should have been strictly dealt with in accordance with any other exporter. So multiple high courts, I would say one was Kerala High Court and other is this Flamingo Travel Retail Limited, where they're categorically mentioned that, this is as good as an export itself and they should be treated on par with export. So good that the judgments are respected. And now this amendment has been done retrospectively, which means that duty-free shops post this amendment, I would say, retrospectively itself, is that whatever supplies that they make. Now, again, over here, there are two aspects we need to look at. One is the departure terminals and the arrival terminals. Now, when it comes to duty-free shops selling, let's say, whatever products from a departure terminal, certainly it is a zero-rated supply, export, and all the input services used can be claimed as refund. Now, on the other context is what the duty-free shops sell in the arrival terminals. The question that comes is whether that also would be considered as an export or, for the purpose of claim of refund. Now, when we look at the Schedule 3 of the CGST Act, warehoused goods, because duty-free shops are considered as a Section 65 under customs as a warehoused goods. Warehoused goods before clearance for home consumption, whatever sale that takes place, it's not been considered as a taxable item under Schedule 3. So it will neither be a supply of goods nor a supply of service. So even that is not taxed. One problem which government has here is that on one hand, on the departure terminal, it has been now considered as an export and full refund would be granted. On the other hand, for the arrival terminals, there is going to be complete credit available and there is no reversal. Because again, under 17 subsection 2 and 3, when we look at, it does not cover the Schedule 3 items. At the most, it covers sale of land and the building aspect, but not this particular item. So this is, I would say, maybe they may come back and next budget, we can see an amendment coming over there. But then overall, I would say it's a good amendment. Unnecessarily, this entire thing has to be done because of the earlier Rule 96A amendment, whatever that was done, once the high courts have rightly mentioned. So I would say this is a good amendment, and duty-free shops, whatever they are selling, it would be treated as export and they would be eligible for refunds. Only arrival terminals, input tax credit, I would say as of now, I'm of the clear view that it is eligible and must be counted for the purpose of calculation of the refunds, whatever that's there. And we need to wait and watch how they look at this later. So Abhay, you would like to add something here? You're on mute, Abhay.
Yeah. So no, credit would be admissible, but the problem is refund at the arrival terminal.
Yes, perfect. Okay. Yeah. So Abhay, you can just comments on this electricity.
Yeah. See, basically, I don't think many of us would be really practicing in this particular area. But anyway, let me just briefly explain. Basically, there are certain electricity generators who basically export electricity to places like Bangladesh, Nepal, where it is permissible and possible. Now, electricity is goods under GST. Although it is exempted, but still credit is admissible, because as far as zero-rated supplies are concerned, the admissibility is not qua whether they are taxable or exempt. ITC is admissible irrespective of the levy. Refund is also admissible because these are goods exporting outside India. Zero-rated supplies under 54 accumulated credit refund is eligible. Problem was with the entire procedural part, that since there is no shipping bill filed for this transaction, how do these companies claim the refund and so on and so forth. So this is Circular 175 that has been issued today, stipulate the procedure. Number of electricity regulations are referred, because since this is a sector which is governed under other laws. So what will be the quantum of electricity which is exported would be based on a certificate issued under the electricity regulations, so as to say, because in absence of shipping bill, that would be used as a document. And then the formula would be same 89.4, where pro rata, as far as the domestic supply is concerned, credit attributable to that will not be admissible. Only credit which is for exports would be admissible. Here again, this is a welcome move in a sense to say that these electricity generators would get refund. But again, as Ravi rightly pointed out, the capital goods would remain still blocked, because in this situation, in fact, capital goods is a significant amount in this sector. But that would, unfortunately, the way right now the law is, that would still remain blocked. Here, they cannot have an option of making exports with payment, because since I said there is no duty on electricity, so that is why only route would be to take an accumulated credit refund, and in that context, capital goods would not be eligible. So I think that is it on this issue.
Yeah, I don't have anything much to add. They've just added the procedure part of it. Abhay, probably you can just take up the next one as well, because
that's a very interesting issue.
A lot of work you have done on this aspect.
See, at times we feel that now GST law is settling. Now, perhaps as a professional, we should start looking at other areas, maybe IBC, maybe attend some seminars, maybe learn something new about. But the board never stops surprising us. In fact, this is one of such surprise. Now, what they are saying by way of this notification, this amendment, is that under Rule 89.4, when you want to calculate the refund amount, which is eligible for you in the context of export of goods made under LUT without payment of IGST, in that context, what should be the value of that export turnover? So let us take a case where, hypothetical case, let us say that I am making an export where the export value is 100 The export terms are CIF. So I need to also incorporate the freight and insurance part of the transaction into my value. It has to be borne by me as an exporter. So, but under the customs law, when I file a shipping bill, I need to indicate an FOB value separately and the component of insurance and freight. So 100, I indicate 90 towards FOB and 10 towards the element of insurance and freight. Now, when I want to compute my refund claim for this particular transaction, under Rule 89.4, the formula says you consider the net ITC, that is the ITC on input and input services. Proportionate of net ITC qua the export value would be eligible for refund. So in this situation, let us say my total turnover is, let us say 1,000. This is export turnover is 100. FOB value is 90. Now what this amendment says that when you want to compute the refund claim, you need to take 90 divided by 1,000 and not 100 divided by 1,000 so as to arrive at the eligible refund amount. So certainly refund amount would reduce, because when you take FOB value, if the transaction is a CIF transaction, certainly to that extent your numerator would be of a lower value, and therefore this would be an issue. Now look at the fallacy of this amendment. Now when you look at Rule 89.4, Rule 89.4 talks about two aspects. Let me specifically deal with that first and tell you how this amendment is not at all in accordance with law. When you look at the formula under Rule 89.4, it says net ITC has to be multiplied by what? Turnover of zero-rated supply of goods and divided by adjusted total turnover. Now they have defined what they mean by the turnover of zero-rated supply of goods. They say means the value of zero-rated supply of goods made during the relevant year without payment of tax. I'm not dealing with other aspects of 1.5 times and so on and so forth. Then they define the word aggregate adjusted total turnover to say that this is a turnover in the state, and then turnover in the state is defined under the clause 112 of section 2 to mean value of supply. So the terms that are used in formula deals with the valuation based on the principles of supply under section 15 of the CGST Act. The term turnover of zero-rated supply of goods as well as adjusted total turnover does not use the language value of goods exported. That language is not there. The language is value of zero-rated supply of goods, not the value of goods exported. There is no such terminology used in entire Rule 89.4. Now, by this amendment, they are trying to indicate that, look, even if we have mentioned that turnover is the value of zero-rated supply of goods and value of supply, already there is entire section 15 to deal with that aspect, where it says that any incidental charges recovered till the goods are delivered to the customer has to be added to determine the value of supply without discriminating that this apply only to domestic transactions and this will not apply to export transactions. Section 15 applies across the board to all kinds of supply which are taxable. So it is in that context that this amendment is now trying to override section 15, override the express language used in 89.4, and to create a kind of an awkward situation by saying that value of export would be like this, but where do I consider this value? Neither in formula says that this value is to be considered there, nor section 15 says, nor the definition of aggregate turnover says. So again, something which could have been avoided. Look, when you want to export with payment of GST, they have no problem. Under Rule 9610, to refund me entire 18% on 100, there are no quarrels with the exporter. Quarrel is only if the exporter is claiming refund of accumulated credit. And in that context, they want to quarrel now and say that in the formula will not consider the CIF value and will consider the FOB value. Now, what is the genesis of this amendment? Genesis is that the board is not able to forget the excise law from their mind when they read the GST law. Excise law was based on the concept of manufacture and removal of goods from the manufactured premises. Port was considered as a place of removal in the context of export transaction. So it is in that context that under the excise law, the view was correct, that the value of export should be the FOB value because the levy was attracted at that stage. It was not a supply-based levy. GST is a supply-based levy. Law is also crafted in that manner under section 15 to include all kinds of cost till that entire supply reaches the customer. Even rule 89.4 considers the aspects of supply and value, which are again derived from section 15 of the GST Act. To create an odd definition of value of export and then to say that that would be considered to be FOB value or the invoice value, whichever is less, something again will create unnecessary problems. Now, what happens to those claims that have already been allowed? Now, probably they would get revisited because they are making this as a kind of a clarification, so to say that this is what we mean by value of exports from day one. So by taking recourse to this, we will perhaps see certain refunds getting called back by reworking the formula, again something which ideally should is not desirable. So in sum and substance, I would say that this is contrary to Act, contrary to the design of GST. It requires to be challenged, and I would not be surprised if some High Court down the line says that this is contrary to law and should not be sustained. So that would be my case. See here, another one more issue happened right now, recently only. What would happen? In the numerator, they would consider 90. But in the denominator, they would go by what they have given in law, that is the aggregate adjusted total turnover, which would be the turnover in the state. That would be again supply-based, value-based determination. So in the denominator, they would take 1,000. They would not reduce 90 from that 10 from that 1,000. So 1,000 would remain 1,000, but 100 would become 90 now in the formula. Again, something which is not desirable. I think board should seriously reconsider this aspect. I don't know why, 5 years down the line, it pains for us as a professionals to really see this approach. On one hand, they are coming with such a positive approach to address certain genuine issues. And on the other hand, non-issue is created an issue by bringing such amendment just to ensure that what view certain officers had has to prevail, come what may. If not through their internal instruction, not through their circular, then we'll make a notification. But our view should prevail. That mindset probably should be, design should be respected. The concept of GST should be concepted, it should be respected. So I think that would be from my end.
Yes, couple of points I would like to put up here. One is that, as Abhay rightly mentioned, that when we look at section 15, it not just say transaction value, it also says all incidental charges needs to be added. And the only differentiation between FOB, COF, CIF would be this transportation and insurance, which is there. So there's no provision I see denying this particular thing. In fact, when we even look at the customs valuation under section 14, it also says up to the place of importation, that is, to the customer. And that categorically, there's a rule to add all these values as a part of a transaction. So I don't see any reason why this needs to be denied. But then comes a very important question: ke, abhi karna kya hai? Again, now what we need to do? Do we need to, see, practically, we all know that in case of refunds, what we have seen that taxpayers, the mentality or methodology is that, okay, instead of 10 rupees, we are getting 9 rupees, but let's get 9 rupees rather than, going for 10 rupees. So ultimately, what's going to happen is that nobody wants to litigate for 1 rupee or so, and businesses would eventually end up, complying this particular aspect. And if the value is considered as whatever that's there as per the invoice, and this formula is not taken up, the refunds would be blocked. So, and the blockage would be entire 10 rupees. And which may end up litigation. Today, we don't even have tribunals to look at, which may go to, 3 years, 4 years litigation on the matter. So a more practical approach would be to go by, FOB value and just claim the 9 rupees of refund. Of course, there will be few who would say, why should I do? And, there will be people who would contest, and that is where the matter would go in litigation. And I go with Abhay that it has to come in favor of the assessee because it's not in line with the provisions of the Act.
See here, just a couple of points. One is, look, when you file a refund claim of 10, it is not the case where they have to accept 10 or reject 10. For officer has a liberty to rework the refund amount as per what he thinks to be the interpretation of this rule. And if he thinks 9 is refundable, 9 has to be refunded at that point in time. So it is not a case where he will reject the entire 10 and 10 would go into litigation. I would believe that he will only reject 1, and that 1 would then get into litigation. Second, see, in certain practical situations like merchant exporter, now I'm having 100% transaction of merchant export. Now in that situation, if I'm making a CIF exports, and in every time, if they are going to consider an FOB value, I would be in a situation where every month on month, I would just keep on getting credits accumulated qua that small portion of that insurance and freight amount. In many cases, we have seen this amount become significant as time progresses. Now, those exporters will have no option but to litigate by considering the CIF value, because if I'm having a 100% export transaction, I am not permitted to claim refund with payment of high GST because I purchase goods at the concessional rate. Now, in that situation, the only recourse available would be to take a CIF value, seek a refund on the basis of FOB value, as that would what the officer would do, and litigate for the differential amount that would stand rejected.
Correct. In fact, taking cue from what Abhay is mentioning is that file an application for 10, fight for 1, whatever that's it, get the 9, fight for 1. And we need to understand that we cannot wait for somebody else to fight and their judgment to come, and then you file an application, because there's a time limit of 2 years for the refund. And landmark judgment of Mafatlal very clearly says in the context of refunds that you need to fight your own battle. You cannot say that somebody else, as Larsen and Toubro, has filed after 10 years. Now you will file an application for all past 5-7 years. Sorry. So if you want that 1 rupee, you would have to make or keep your refund claim alive. That is very, very important. Next, I would say very, very important amendment in the context of refunds, and rather a welcome amendment. So we all know that because of this COVID, there was a Supreme Court order granting extension on various things. And there was the word was applications as well in that particular relaxation which was there, which was time and again extended right from I would say 22nd or 18th March or 22nd March up to February 2022. This particular extension was there, which was ultimately given another 90 days of life, so coming up to 30th June 2022, wherein if any applications or any other compliances which were listed out, including filing of appeals and all these things, were extended. So 30th June, this extension came to end. Now, by this particular amendment, now when that extension or that whatever relaxation was of Supreme Court which was there was always an interpretation how to interpret that, whether we need to treat this entire period as excluded, or we need to consider the ultimate deadline up to 30th June 2022. This was always an issue. In fact, department came out with a circular categorically stating that only quasi judicial functions would be considered, and kind of indirectly, not considering the refund application aspect over there. Of course, later there was a Bombay High Court judgment, and multiple high courts have categorically mentioned that refund application must also be read in the same context, and this must be given. That relaxation of Supreme Court must also be available for refund applications. So now a good amendment, I would say, where department has categorically laid out that refund applications also would be considered in this limited. Now, one important reading of this amendment is that the time limit to claim refunds largely is 2 years, correct? From various relevant dates, whatever that is there. Now, this time limit of 2 years, while calculating the period from 1st of March 2020 to 28th of February 2022 needs to be excluded. So exactly 24 months goes out, which means a 2-year period goes out straight, right? So now February 2022 till now, if I would say another 3 months are now over, correct? 4 months are now over. So in a way, removing these 4 months, another 24 months also are to be excluded. So all in all, you can go back 20 months prior to February 2020, which means I would say an assessee would be eligible for refund right from July 2018, June 2018 rather, correct? So this, in my view, is a very, very, very big amendment. Lot of assessees for that matter, education cess related judgments which have now started coming that refunds are eligible for education cess. In the case of builders, where they have paid based on 1/3 valuation, while now we have a Gujarat High Court judgment stating that need not be the case, and many of the cases builders have not collected tax. Let me tell you, builders were the most fearsome taxpayers as far as this anti-profiteering was concerned. They paid 7% out of their pockets. And when this amendment happened of April 2019, I see so many builders in Pune actually paid 7% out of pocket and collected only 5% from the customers. So host of matters where businesses have paid excess tax. One aspect which I would bring out, which I see very important, is the employee recoveries. Now we have one more amendment dealing with that employee recoveries, would not be liable to GST. And I can tell you that companies have paid each year, right, ranging from 5 lakhs to 1 crore every year on these employee recoveries. Hardly companies have recovered this money from the taxpayers. So all these contentious issues, one has to look at going from 18, 19 onwards and see what is the excess tax that has been paid and pursue filing an application for refund. Of course, very, very important aspect which we need to understand, that this would be subjected to unjust enrichment. So if you have collected the tax, then certainly the refund could not be eligible. As far as unjust enrichment is concerned, we need to also look at how this has been treated in the financials, whether it's been expensed out or carried as an asset in the financials. So that is also another very important aspect needs to be done. So I see that is where one issue where a lot of applications may not sail through. But otherwise, it's a very good amendment. Just to patch up this amendment with the next one, since government has given the benefit, they also want to take back something from you. So considering the same Supreme Court judgment and, because of COVID, they say that even demands which the government would now raise in the case of erroneous refunds that's been granted stands extended to that extent. Now here again, this 2 years time limit for refunds related demand is going to give a big leeway for government to claim, because when you see the time limit for refunds related demands, actually speaking, it is not linked with annual returns. It is linked with the, when the refund was sanctioned. So it is not linked with annual returns. So most there would always be certain demands which are already expired. The 2 years have already expired prior to 1st March 2020. In my view, those demands would not sail through in this benefit. But then others, government would have the time limit to claim the to ask for the erroneous refunds granted beyond this considering this exclusion. So Abhay, over to you on your analysis on these two aspects.
Right. So on the first, I agree. The additional aspect that one can consider is the fact that when Supreme Court dealt with this issue in a suo motu petition, Supreme Court granted 90 additional days on and after 1st of March 2022. If the balance period of limitation that was left after this date was less than 90 days. If the balance period of limitation was more than 90 days, then that longer period would apply. So many persons, taking a clue from that, have filed, for example, let us say a July 18 application in a situation where, let us say in April 22, considering that 90 days is available. Now, by this notification, they are saying no, only this period has to be excluded. So the moment I exclude this 24 months, in that context, I was supposed to file that application immediately in the month of March. Since I filed it in the month of April, technically this notification would say that this refund is time barred. But the Supreme Court decision would say that the refund is not time barred because Supreme Court gave me 90 additional days, even if the balance period available with me was less than 90 days. Now, as you are aware, under Article 141, the law of Supreme Court has to prevail. So I think that should prevail in this situation. This notification is required to be overlooked in that situation where persons have claimed that 90 days limitation benefit and under that decision. That is number one. Number two, now, interestingly, this notification extending the 73 timeline would be much into litigation. Now, why I am saying that? So if you look at section 73, that is a situation where the department wants to recover any unpaid, short paid tax or erroneous credit in a situation not involving fraud. This would also become relevant if a case is made under 74 and ultimately declared by the authority, maybe quasi-judicial, judicial, to say that there is no fraud, and therefore the case then turns back to 73. So 73 timelines in any case would become relevant even from that perspective. When you look at 73, it specifically provides under subsection 10, that the order that is to be issued should be issued within 3 years from the due date of furnishing of the annual return, and in case of refund from the date of the grant of that erroneous refund. So 3 years timeline is specified in the Act. There is no power given under 73 to extend that timeline, number one. However, because of COVID, government introduced section 168 capital A by virtue of the TOLA, what is referred to as taxation and other laws amendment in 2020 to, in a way, assume power to extend any timelines given under the Act through a specific notification in a situation where the actions could not be completed or complied due to a force majeure. So COVID is considered as, in fact, that is again a debate whether COVID is a force majeure, because when government companies, PSUs want to pay, they declare a force majeure clause, and when they don't want to pay, they say it is not a force majeure event. So in any case, let us assume COVID is a force majeure. So by virtue of 168 capital A, that this notification has been issued. Now that applies only in a situation where any action that was supposed to be completed within that time frame but could not be completed is what permits the government to issue a notification. Now, normally, section 73 timelines for 17-18 would only expire after this COVID period of February 22. So it is not the case where action under 73 was supposed to be completed by the officer on or before 20th Feb 22, and because he could not complete that action, by virtue of 168 capital A, the government is exercising that power and extending that timeline beyond February 22 with a new timeline. So I believe this is a situation where the government could not have exercised the power, because in any case 17-18, the due date of filing the return was February 20. So 3-year timeline would expire only in 23, somewhere in Feb 23. That is still a time to go. So now stepping in and preempting and saying that we will not be able to complete the action even by January 23, and therefore now we want time till September 23 to complete the action, certainly is not what 168 would permit. The language of 168 would not permit that. Language of 168 would only permit extending the timelines for those actions which were required to be completed but could not be completed because of this force majeure. So technically that action required to ensure that the due date for taking that action has to fall within that force majeure event when that event happened. Otherwise, you cannot say that was required to be completed because of that force majeure. Number one. Number two, now 73, if you see the structure of 73, it talks about 3-year timeline for passing an order. And it also, under subsection 2, gives a minimum period of 3 months before the passing of that order to issue the notice. So there are two timelines in a way. 3-year timeline, outer timeline, you can say, for passing an order, and a 3-month gap, minimum gap before that outer timeline to issue a notice. Now, when you look at 168 capital A, it grants the power for extending a specific timeline under the Act. Now, what is sought to be extended is only a timeline under 7310 from the 3-year to September 23. So I would take a view that timeline under 73.2 that is linked with original 73.10, which is not amended. Please understand that provision is not amended. Only by virtue of 168 capital A, that timeline for this 17-18 financial year specifically has been extended. So when I look at for 17-18, again, the timeline for issuing a notice, that 3-month time limit has to be computed considering the limit that is specified under subsection 10. That limit continues to be 3 years from the end of that relevant due date of filing of the annual return. That time limit does not stand extended. So show cause notice requires to be issued before for 17-18, if you take a situation, since January 23 would be the timeline for issuing the order. So show cause has to be necessarily issued somewhere before October 22. if a situation happens that show cause is not issued within that timeline, but order is issued, let us say by September 23, that is because of this notification, if we consider it to be valid, certainly an argument is required to be taken to say that, look, this notification did not allow you to extend timeline under 73.2. This only allowed you to extend the timeline for issuing an order under 73.9. Read with 73.10. So in that situation, since show cause has been issued beyond what is permitted timeline, the proceeding should not be held to be valid. So that is again something that has to be considered. So that would be perhaps my take on these two amendments.
Very interesting analysis, Abhay, on this particular aspect. I completely agree with your point that how can they assume or preempt a situation when it was that entire limitation was not there within the COVID period, and the due date was well beyond. I would say January 2023. It is the due date anyway.
In fact, Supreme Court took passed 3 orders as the COVID progressed, considering the real situation and then extending the timelines. Yes. We have a case where government is preempting that COVID would again come back.
This is little funny, I would say. And in fact, when I was just trying to do the calculation, 2018-19 due date would probably come before 2017-18.
Right.
On that, because that is only for 17-18 if you read that particular amendment.
Yeah, it is only for 17.
So, okay. So I think next two are little, I would say.
So we have a common SCN considering 17-18 and 18-19.
That's going to be more funny on how that would be interpreted. Fantastic. So there's a huge scope, this is called creation of litigation out of nowhere. So next 2 amendments.
I would say this is basically inviting litigation out of nowhere.
Exactly, correct. So there's a huge litigation that's on the way, especially the way in which the notices and orders that have been coming. And now the time limit is also extended. So
and we would not be surprised once this power has been tested. Tomorrow, on any ground, they may come back with 74 amendment. So for their laxity in doing their work within the timeline.
I hope there is no officer in this audience.
No, even if I think any officer would see, openly, they may not say it, but they understand what we are trying to convey. And they understand the spirit with which we are trying to convey. It is not a case where we are taking a view which is only biased to the assessee. We are taking a fair view, saying that when for refund claim, you are saying everything the clock stops at February 22. And only that period has to be excluded. So that same spirit has to be respected when it comes to their action. You cannot have a two divergent set of rules or principles, so to say, to apply. And 168A.
Yeah, even departmental officers are facing issues, sir.
Correct.
But anyway, practically, Ravi, I'll tell you, all notices would come under 74. So anyway, this is morely theoretical.
I would say, agree. Everybody is doing fraud that way. Okay. So Abhay, would you like to take the next 2 amendments, which are, I would say, clerical? I would just come in a minute or so. We just take these 2 amendments.
Yeah. See, basically, this is dealing with the duty credit scripts. Now, duty credit scripts, when GST was introduced, was taxable. Then they reduced the rate because earlier in the pre-GST era, this duty credit scripts could be utilized for discharging both custom duty as well as CVD when you make imports or even domestically when you purchase against an advance license or an invalidation letter. Post GST, the purpose where you can use these scripts was restricted. You can only use it for discharging the duty, the custom duty. So you cannot use it for discharging the IGST, and therefore the value of those scripts was depreciated on the onset of GST, considering that it will have a limited usability. So in that background, government said that we need to help the industry, and in right spirit, initially they reduced the tax rate from 18 to 12 somewhere in August 17, and from October 17 they made it exempt. just to ensure that the value, this factor basically does not depreciate the value. Now that created a problem, because now if you declare this as exempt, we have a situation where, let us say there is an exporter who has earned this duty credit scripts on exports. He is himself utilizing this duty credit scripts against the imports that he is making. No problem. There is no supply of duty credit scripts, no exempt supply, so no credit reversal required. No issue on that from day one. Issue arose in a second set of facts where the exporter was not having that opportunity to utilize the scripts that he has earned, and therefore there was a market available, so he could trade those scripts. He can sell those scripts to other eligible importers. So he does that, and because of that exemption, he does not charge GST on that supply. Now the department took a view that since this is an exempt supply by virtue of section 17(2) of the CGST Act, read with 17(3), the ITC attributable to this supply would not be eligible, so it would be restricted. Now the dispute arose that how do you compute that restricted ITC? Now a situation that we are considering is like this, that the exporter is purchasing inputs, utilizing services to manufacture the goods. Those manufactured goods are ultimately exported, and then after export, he becomes entitled for that script. And to get that script, he has to also incur certain additional efforts, certain additional activities in terms of maybe engaging a consultant for DGFT matters. That consultant would advise him, would visit the DGFT office, submit the paperwork, and that can get those scripts credited into the account. Department took a view that when you want to do the reversal under Rule 42 in respect of inputs and input services, you consider all the credits that you have earned during that period. Why? Because without manufacture, you could not have exported. Without export, you could not have earned the script. And therefore, even the credit which is attributable to inputs, raw material, would also be considered for reversal, because without that raw material, you could not have earned the scripts. So that was the view the department took. Number of petitions were filed in the High Court. In fact, in Gujarat High Court, in fact, our 5 petitions are right now as we speak pending. We said that, look, this credit reversal should not apply at all, because the objective of exemption was to avoid the depreciation in the value of the scripts. It was never to per se restrict the credit vis-a-vis the supply of the scripts. And please understand, this is a script which is a post-export benefit. So it is not a case where you can link the raw material to the script. Scripts are basically given after the export is undertaken. We also made up in the petition, took a ground that, look, when you look at the basis of that script, if you go to foreign trade policy under chapter 4 of the FTP, you will find the entire genesis of this script. What is written there is that this is because of the infrastructural inefficiencies in our country, and because of that the cost increases. To mitigate that, these scripts are given, and that is why in fact the US challenged that entire scheme before WTO, and then we had to abandon that and now come with a ROTAP. Now in that background, what we indicated is that, look, this is a script given to me as an entitlement for the general infrastructural deficiencies. It is not to mitigate my input cost, not to mitigate my input service cost. So the scheme itself is clear in terms of saying that my inputs or input services are nowhere attributable to the income that I derive from the sale of these scripts. So in that situation, no reversal should be required for any credits. Now those matters are pending. Now what they are saying by bringing an explanation to Rule 43, which will also apply to Rule 42, that this value of this script would not be considered for the determination of the value of exempt supply for purpose of ITC restriction. So it is in a way good. Only lingering element, again something which I don't see that, but as we know, we have officers. Only lingering element is like this, that look, the value of export to which this explanation applies is required only when you want to attribute the common credits. So that one is very clear that no longer this value of scripts is required to be taken. And this is an explanation which will apply right from October 17, when the scripts were exempted. So no issue on that. But what about a situation where there is a specific credit qua that script? there is a consultant that you have engaged who is issuing an invoice for getting those scripts or advice on those matters. In my opinion, there also no reversal should be required, because as I said, the entire script is given to mitigate infrastructure deficiencies. It has nothing to do with my other costs. But there, this explanation technically does not apply, because it does not say this is not an exempt supply. It says only for the value of exempt supply, this would not be included. So that applies only for common credits. But the spirit has to be respected. Once you say that this is not part of value of exempt supply, even for specific credit, you cannot have a view where credit can be restricted, because it would be a discrimination. When you say for common credit, I would have no problem, but for a specific credit, I will have a problem. Now that view certainly cannot prevail. So that would be my take on that aspect. Second, e-invoice, basically it's a procedural amendment where they are saying that there are entities where e-invoicing is not applicable, even though their turnover is exceeding the criteria. So for example, let us take a unit located in SEZ. Now, SEZ units as on date are not mandated to issue an e-invoice, even though the turnover could be above 50 crores, whatever limits as and when they were. Now what they are saying that such units are not required to still issue e-invoice, but they will have to print a declaration on that invoice, which would be a regular tax invoice that they would be issuing, indicating that they are not issuing e-invoice because they are not required to issue an e-invoice. So that kind of declaration, I don't know what can be the purpose. Maybe the purpose could be to alert the recipient that why he has not issued an e-invoice is because he is not required to issue an e-invoice. So that fact, which otherwise they were communicating through email, now that fact would stand communicated through a declaration on the invoice. Otherwise, I don't see any other, motive. I don't know if Ravi can enlighten us with any other motive that they may have. I could not find any.
I'll tell you, Abhay, the motive. What will eventually happen is that because you do not have this declaration or your invoice, I will deny you the input tax credit.
Okay.
Of course, that's not the motive, but eventually that would end up or land up, I would say, because, in excise and VAT and all those things we've seen, mere procedure, some address not there, some declaration, some specific not there, and credits were denied. So that is my only fear with that amendment, which is there. Otherwise, of course, it's a procedural aspect which is there, because now transporters are also going to come under forward charge with the amendment that's coming in. So my another question is whether transporter e-invoice, whatever that was there, was again needed, continued, not needed, all those things, and then whether this declaration, how it is going to impact, is something needs to be looked at. And I go completely with Abhay on that duty credit scripts related aspect, that there is no service categorically used specifically for that. Okay. So next, this particular amendment is in the context of deemed exports. Very interesting amendment, or I would say understanding what that we need to take out of this entire thing is that now in the context of deemed exports, let's say when a person supplies the goods to EOU or against the domestic advance authorization license or EPCG license, that transaction is considered as a deemed export, even though both supplier and recipient are within the taxable territory, and the supplier needs to disclose GST on the invoice, and the refund of the GST, whatever that's disclosed, can be claimed either by the supplier or by the recipient. That is the law, and that has been called as a deemed export. Now, the issue that was coming is that when the recipient was claiming the credit, the mechanism in which the credit was being claimed is that it is declared as an ITC, and then the claim was lodged. So department officers were denying the credit in cases where the subject character of the transaction was ineligible credit, let's say canteen or whatsoever. And the fact that it is classified as a deemed export and the tax has been paid, it is more of a tax rather than a ITC reversal that's required on this. So that was the issue that being faced. So which has now been clarified that when the supplier raises this invoice as a deemed export, and when let's say recipient is going for claiming the refund, it should not be subjected to the provisions of section 17 of the CGST Act. I would say it's a good amendment. And this is a view that we have taken earlier as well for a few of our clients. When this question came, I would say 3 years back from one of the EOU clients. But now, interestingly, one, I would say, thought process that comes to my mind, let us say there is an EOU. And they have a huge construction activity to be undertaken in their this thing, huge civil construction and the big construction to be undertaken. And if this particular thing is been undertaken as a deemed export from the supplier, as a domestic deemed export, and strictly speaking, construction, civil works, the credit, is ineligible. Now, if this particular thing is been taken as a deemed export, and rather than the supplier straight away billing and recipient claiming ITC, and it is taken a route of a deemed export, would that lead to a, this particular clarification coming in play that it will not be going through the rigors of section 17 and full amount would be eligible as refund either to the supplier or to the recipient? I would say that is going to be a very, very big positive impact for the EOUs in this particular context. So that is, one important dimension that I could make out in this. But yes, I would like Abhay to add his views on, more specifically the point which I have raised here.
See, two views. One is basically when we say canteen expense, basically deemed export is only restricted to goods transaction, supply of goods. It does not extend to supply of services. So canteen service provider providing the canteen supply to an EOU cannot be considered to be deemed exports so as to be eligible for refund under that category. So that perhaps would have to be considered. As far as the civil related expense is concerned, I would say that you look at notification 52 by 2003, under which the EOUs can claim the benefits as deemed exports. There you will not find this category of supplies covered as deemed exports. That is restricted only to the input services, and there is a certain list of capital goods that are eligible. So perhaps one may find some difficulty. I don't know, one may consider this as inputs to say that in excise we had certain decisions where they say that if you are yourself undertaking construction, then when you purchase cement, it is an inputs, not a capital goods. So perhaps maybe on that basis one may make a case, but difficult because the policy under EOU is not to consider these as deemed exports, civil related expense particularly. Yes, other expenses I agree which are under 17.5. Certainly this what Ravi has highlighted, certainly that can be exercised and it will be a big benefit to the industry. For civil related work, I am a bit apprehensive. I don't know. I will have to really check that notification and see whether this expense fits into that deemed export category. Normally, you will not get an advanced license other than EOU if we talk about. You will not get an advanced license or an EPCG for such expenses. So that can be an issue.
Yeah, that would be interesting aspect to be looked at, because when you look at the CGST notification, it simply says supplies to EOUs. The CGST notification that's there. So I don't see there the reference to the foreign trade policy, but of course, I think both these notification has to be simultaneously read to see whether this deemed export related thing can be claimed on this part. Perfect. I think next two again are more of it's highlighted in blue because they are not yet notified. On the accumulated ITC in the context of edible oils and coal on the inversion, they would not want to allow the inverted rate structure refund. I don't see any reason because generally the rate also would be the same. Maybe because of packing material, the cost or inversion may be coming in, but I don't see any much reason why this has been denied per se. Next important amendment is in the context of this advance authorization EPCG, where every now and then this extension was happening on the context of IGST exemption. It's basically they wanted to implement the e-wallet scheme, which is I don't think they are anyway further looking at that scheme. So they are now planning to give this permanent exemption to this particular advanced license and other these things. So anything Abhay on this?
No, it's fine. It's perfect.
Perfect. So now we need to take up. So now there are other aspects to be taken up. Now is another. We have 60 minutes. Streamlining of compliances plus the industry related benefits. The industry related exemptions. A lot of notifications have not come, and it's all a lot of ifs and buts. So we'd like to take up those things in last 15 minutes or so. Or so Abhay, I would say now probably we would have to go a little faster to cover the streamlining of compliances related aspects. So you can take
I
up
think
this.
major law points are as such over. Now this is
More of procedural aspects which are there now. Yes. So this first one, Abhay, you would like to take up on this interest.
so basically, as the participants would be aware, Section 50, subsection 3 was amended. Now they are saying it will come into effect. It is a retrospective amendment applicable from July 17 to say that interest would apply only where the credit has been utilized, the erroneous credit has been utilized. Interest would not apply where the erroneous credit has been availed and not utilized. Then they are also coming, they have also come out with a circular indicating or notification indicating the manner in which that credit is to be worked out. They are saying basically in a nutshell that let us say in this 1 month A, you have a credit of 1 lakh where 10,000 is erroneous. In the next month, you utilize 90,000, but 10,000 remains as a balance. Then they will consider that 10,000 as that erroneous part, not on a pro rata basis. That is a welcome amendment. And if let us say at that point in time, you reverse 10,000, no interest. It is only if let us say in the third month, you even utilize the 10,000, it is from due date of filing return for that month that the interest calculation would start at the rate of 18% till you deposit that credit back. So that I think is the amendment under 53.
Correct. Only few things here I have to add is that there are two things. One is 51 and then 53. Now 53 is in the context of reversal of ITC availed and utilized. So now that has been taken care. The 24% aspect is still not yet notified. It's only on this aspect. But then few things which are still not clear or not there is in the context of 51, where they say that to be paid based on debit in cash ledger other than the self-assessed tax. So let's say if there is an outward tax coming in on and which the interest is coming in because of inquiry, investigation, or some sort of commencement of proceeding under Section 73 or 74, because that is considered as an exception or except those items, would that by interpretation that in those cases, it would still continue to be on both electronic cash ledger and electronic credit ledger? And if that is there in 50 subsection 1, why that corresponding thing is not there in 50 subsection 3? And to that extent, there is an anomaly that interest calculation to the extent of reversal of ITC availed and utilized is there's no restriction, even if it is coming out of demands or whatever investigations proceedings. But for outward, that is the exception that's been created. One part which is somewhere I feel it's correct. Second is why just credit ledger? Even the cash ledger has to be looked at. You know, Vishnu Aroma, we have Gujarat High Court judgment where money is already deposited. So somebody told, no, that money doesn't come to the department. It goes into the treasury of department. It's not like a Paytm. Hey, jab chahe return le lo. You know, you have to file an application. You want that money back. So it has gone into the treasury of department, deposited on 20th. Now you say that will not be considered. That's just a deposit. I don't understand. I would say even that benefit must be given. But that is also not categorically coming out. So these are two issues I see as far as interest is concerned, that's going to be there. Yeah. So we move on to the next aspect. I mean, these are the procedural things we have told how to calculate the interest and mechanism of it. Next amendment is in the context of transfer of balance in the electronic cash ledger. Let's say I am a SSC having registration in both Maharashtra and Haryana. I am paying, I have huge balance in my electronic cash ledger in Maharashtra and not there in Haryana. So CGST and IGST can be transferred. Of course, SGST is state specific, so that cannot be transferred. So this is a good amendment. It will ease the working capital. But I would say, ideally, this amendment should have extended even to the electronic credit ledger. That is when the real working capital benefit would have come to the businesses, because hardly I would see businesses who would put money in the cash ledger. Earlier in excise, people used to do. Even today, there are 2-3 lakhs people keep just to avoid interest and all those things. But then in excise, there was this concept of large taxpayers, LTU, where this benefit was there. For them, this has become such a big disadvantage. So I would say government must consider extending this benefit to credit ledger. That would certainly ease a compliance substantially. But still, to this extent, the amendment is good enough. Abhay, anything you would like to add here?
No, it's fine.
So next is very interesting amendment. I would ask Abhay to take this up because huge issues faced on recoveries, and again, between the lines, how do we read this? So Abhay, on this employee recoveries, you can just take up.
Right. So basically what the circular only reiterates what they had already indicated in somewhere in, I believe, July 17. What they are saying basically that if certain perquisites are given by an employer to an employee as part of the employment contract, then those perquisites would not be liable to GST. So basically, since it's part of the employment contract, so perhaps referring to serial number 1 of Schedule 3, they are saying this is outside the ambit of GST. So there is no quarrels, it's fine. Another good part is that July 17, the press note, it also had one qualification saying that only if the employer has paid GST on those supplies, then that would not attract GST, the perquisites which are given to the employee. Now that was totally bogus, because that is a totally independent transaction that has nothing to do with this aspect. So it's good that this circular does not have that qualification. So even an employer getting, let us say, a catering service from an unregistered supplier not paying GST and recovering a part of that from the employee as part of perquisite, and part giving that as a benefit in terms of perquisites, that would not be liable to tax, both on the input side and on the outward side. So that, I think, reiterates the view that basically supply necessitates an intent to avail the goods or services in question. If something as a part of a condition in the contract of employment is given some benefit, then a larger bargain of employment has to be understood. And from that bargain, sub-bargains cannot be dissected and brought to tax by saying that, look, larger bargain may be outside GST, but a sub-bargain of that larger bargain will be treating it as an independent supply. And since you have recovered some money from the employee, it would attract tax. Certainly that view is not something that perhaps maybe would have prevailed. But in a way, now we have a circular saying that will not tax sub-bargains in a larger employment bargain. The only condition is that the employment contract should stipulate those sub-bargains. Please make sure that happens. Not necessary that it should be part of the appointment letter. You can also have a mass email indicating that as terms of employment. In addition to that, as an employer, you are giving these benefits or these perquisites. If you have that, I think you can apply the circular and not pay tax on that transaction. Also, this transaction will not be considered as an exempt transaction, because the circular does not say it is an exempt transaction. So no ITC would be required to be reversed. Let us say this outdoor caterer would have charged GST, for example. If, let us say, this is a factory where under the Factories Act, it is mandatory to provide canteen facility to the employees. So there, the credit is not restricted under 17(5). So in such a situation for such employer, credit would also be admissible. On the other hand, he would also not be liable to pay any tax on the perquisites that he provides to the employees on that aspect. So that, I think, is fine. I don't see the only problem that I apprehend on the credit side would be that we have an ultra-tech decision of Bombay High Court in the excise context, where they say that if you recover part cost, then to that extent, you need to surrender the ITC. Now there again, I have a different view, because High Court in that context just said that if you recover part cost, the principle was that since you have recovered past cost, you would have also recovered part tax on that cost embedded into it, and therefore to that extent the ITC you cannot retain. In a practical situation, when the employer recovers a part cost, he does not consider the GST element. So for example, if the plate cost is 50 rupees plus GST, and if he recovers a part amount from the employee, he would recover, let us say, 10 rupees, 20 rupees, which would not consider the GST element. And he would, because he would have anyway availed the credit of that entire GST. It is not something which was anyway a cost to him. So he would not have passed on that cost or a part of that cost to the employee. So in that situation, I would take a view that ultra-tech facts are different. You cannot, although the judgment says if you recover part sandwich credit, you need to reverse. But it has to be seen in that factual context where this fact was never indicated to the court as to whether in that situation they were recovering excise element also as embedded into that recovered portion. So that view remains, that argument remains, that if, as long as I'm not recovering GST, I would be entitled for the full credit, even if basic amount of that supply I may recover from the employee as part of the perquisite arrangement. So that would be my take on this approach.
Yes, so I would just add 2-3 points here. One is because of this, businesses took conservative positions and started paying GST on this particular aspect right from 17-18. And there was an amendment wherein it also stated this canteen more specifically as 5% and the corresponding credit restriction on that. So eventually business took a hit of 10%, 5% on the purchase and next 5% on the outward. Now, actually speaking, this amendment brings 10% benefit, not just 5%. One is on the 5% not payable and other, but 5% you're not taking, you can actually take. This is one aspect. Second aspect is for the past. Now with the refund application related timeline extension, I see this as a very good opportunity to file an application for refund because this is a clarification. So this means it has to be read retrospectively. It's not a change in the law. And that would be very big decision which the organization would have to take as far as this amendment is, this particular circular clarification is concerned. And third aspect, I would say a little contentious aspect is many times in the factories, while the recovery happens from the employees, it also happens from the workers who are not wage laborers, who are not the on the payroll per se as an employee. The question that comes is whether the recoveries that are being made on those workers or the wage laborers as well has to be read in this context as well. I would say yes, because when we look at the various provisions of this contract labor and at all those things, of course, the principal employer is ultimately this person only. So in my view, the term employment agreement and employer has to be read in more of a purposive interpretation, and it should not come that only people who are under payroll this is there and others it is not there. So I would kind of extend this benefit further as well. So I think the next part, Abhay, we already covered in the earlier discussion itself. So now this is, I would say, okay, so my partner from NCR, Ashish, he called me after reading 3 times. He's telling Ravi, jitni baar padhte hain, mere ko samajh aur confusion badhta hi hai. Ye fake invoicing, exactly what is that they're trying to do. But Abhay, you would like to take this up, or how do we do this?
So since we have time limitation, whichever way you find, I mean, I can take it up if you want.
Yeah, you can take it up, Abhay, and let's try to give a gist.
Summarize,
summarize
give the crisp the summary of that. Basically, look, this fake invoicing, as you already, many of you would have, all of you almost would have read in the newspapers. A lot of rackets department has busted and cases are now going on. The issue comes up that how do the department proceed against the person? Because when you look at fake invoicing, it's a chain of transaction that happens where A, B, C, D are in the chain, and one generates the invoice, one just does the work of passing the invoices, and one actually then consumes the credit and uses that in discharging the actual tax that he is supposed to pay for the genuine supply that he has made. So department always was in a fix how to go and proceed against A, B, or C in that situation, where let us say A is a person who generates the invoice, a manufacturer of invoice, let us say. B is a trader of invoice, let us say, purchasing the invoice from the manufacturer and selling the invoice to the consumer. And C is the consumer of invoice who has actually consumed the invoice and utilized the credit in discharging the actual tax that he is liable to pay on actual supplies that he has made. And what the circular says that for A, since he is only a manufacturer of invoice, we cannot recover any tax because tax is on supply. Supply requires a transaction in the nature of sale, so on and so forth under Section 7. Since we are saying ourselves that there is no actual supply, where is the question of recovering tax on that supply? So circular says, look, 74 cannot apply in this situation. 74 applies only if tax is to be recovered along with penalty. So penalty under 74 cannot be imposed on A because A is not liable to pay tax at all under 74. So the circular says, look, we have another 122 where we have certain situations where penalty is attracted. This is a situation covered under clause 2 where it says someone issues an invoice without underlying supply. So that is the offense that A is committed by manufacturing this invoice. And therefore A would be liable to penalty under 120. For B, they are saying, look, B is a trader of invoice. Yeah, he purchased that invoice and supplied it to C, who is the consumer of invoice. Both the ends are fake. Purchase is fake, sale is fake. Circular says here also, what can we do? We cannot take tax from him because there is no supply he has done to C. On the credit front, the circular says, in fact, credit is not eligible, but since he has also, in a way, reversed that credit, so to speak, on a further invoice that he has issued to C. So neither credit nor tax can be recovered under 74. So here again, circular says, forget 74, go to 122. Circular says here that B has committed two offenses. One offense of taking the credit without invoice, without genuine underlying supply, and B, issuing an invoice without supply. So because there are two separate offenses he has committed under two separate clauses of 122.1, clause 2 and clause 7. Therefore, he would be liable for double penalty. So there will be a penalty, double amount of the tax amount involved for B, who is a trader of invoice. On C, they say, look, C is the consumer of invoice. He has now consumed the invoice and used it in paying genuine tax. So what offense he has committed? He has availed an ineligible credit under 16.2 because he has not received the goods or services for which he has availed the credit. So in C, 74 would be invoked. He would be liable to pay the credit back because credit is ineligible, along with penalty under 74. 74 does not apply to A and B because A and B were never liable to pay tax or in that situation. But since C has availed a credit which is not genuine and used it for genuine payment, he would be liable for recovery of credit along with penalty. Circular also addresses the issue for C, saying that can C be again liable for penalty under 122 for taking the credit without underlying supply? The circular rightly says no. Look at 75.13. It has a double jeopardy clause where it says that for a single offense you cannot penalize the person twice. So since for C you are already going to levy penalty under 74 for availing wrong credit, you cannot again penalize him under 122. So for C, there will be only a single penalty under 74. So in a nutshell, A will be liable to penalty once. Let us say 100 rupees is the tax fake credit that A has generated, manufactured. A would be punished for 100. B would be punished for 200, 100 on inward side, 100 on outward side. And C would be punished for 100. Of course, credit would again be recovered from C because ultimately basic 100 no one has got. So that 100 would be recovered from C and 100 penalty also from C. The circle also says that this is a very plain vanilla situations that we have discussed. Real world is very complex, but the principle would remain the same. And that is why I explained the principle in terms of naming the persons as manufacturer of invoice, trader of invoice, and consumer of invoice. Principle would remain the same, that the liability to pay the tax would only fall upon the consumer of invoice. The manufacturer of invoices or trader of invoices would not be saddled with the tax liability. That is what circular also says at the end, that look, all this we have said, but 132 is also there, prosecution provision. So that would follow in facts and circumstances of the case. So this is basically the circular. Now, what are the issues with that circular? Number of issues are there. We have very short time limit, so I will just deal with one or two.
We can cover in bit detail, because this is certainly one of the most critical. But yes, certainly currently we have 35 minutes, but yeah, another 5-7 minutes you can give to this aspect.
See, basically one issue, of course, is a factual issue, that to say that one has given an invoice without underlying supply is not that easy, because it's a factual issue. So one has to look at all the evidences and then perhaps reach a conclusion. But this an alternate argument can be taken in a situation. Let us say government says to you that this is a fake credit. On one hand, you argue that no, it is not fake. But alternate argument could be, if it is fake, then look, I also made further supply, either by using those inputs, or that if this is fake, that is also fake. And now if that is fake, then what is the question of now? Because then I am B in this circular. Now, if I am B, then on that ground, how you can recover any credit from me? Because you yourself are saying as an allegation in a show cause notice that this is fake. So, see, what will happen practically is officers would not be that much cautious when they will draft the show cause notice. They will go all in. They will say whatever they want to say, And that will create a problem for them only, because if they penalize B under 74, that penalty will not survive. If they penalize, let us say, a person saying that a fake credit, the person demonstrates that, look, if this is fake, I have already reversed that by making an outward supply. So that is also fake. Now, if that is the situation, then in that situation, only 122 could have been invoked. 74 could not have been invoked. When they straight away invoke 122, once you demonstrate it is not fake, then that entire case will collapse. So officer will also have to be very much cautious how they want to issue a show cause notice, because you are all aware, adjudication cannot travel beyond show cause. So if show cause raises 74, 122 cannot then be resorted to. If they raise 122, 74 cannot be resorted to. We have seen so many such cases of show cause notices for alleged fake invoices where they were only limited to 74. Now with this circular, there is a strong argument to say that now 74 cannot apply. You yourself are saying, I have taken fake credit and I am now saying that I have also supplied those goods or those as underlying supply further by so and so invoice. So that is one. So perhaps this circular will be revisited. This entire, for B, the consequences would have to be reconsidered. I don't think government would be that much gracious enough the way they have been right now in this circular because by this way, a lot of crooks would get a way out, which certainly is not desirable. Even as a good practitioner, we would also not want that to happen. So in that motive, I think the way we made certain suggestions in the earlier discussions, here also, I mean, balance few demands that a similar suggestion has to be given to the government. Legal points, legal issues would happen. Legal issues would be that courts are not bound by this circular. So courts may go on their own tangent. They may respect the circular. They may not respect the circular. Courts may take third view. How they would take, only time will tell. Now the question is that if, let us say, any out of this A or B wants to settle the dispute by exercising an option under 74, by paying the amount before show cause or within 30 days of show cause, as you are aware, there are options available under 74 to abate the proceedings. Now, the way right now 74 is structured and those options are structured, it only applies where any tax is to be demanded. And then 15% of that is to be paid before show cause, 25% of that within 30 days from show cause. 74 is not structured to cater a situation where only show cause levying penalty under 122 is issued. Because 122 does not have a separate mechanism to issue a show cause. Ultimately, for issuing the show cause, the officer has to travel to 74. If he travels to 74 and based on that circular, only 122 is to be imposed, then in that situation, for that particular taxpayer, how can he take the benefit of that 15% option? Because that was never, that as on date is not formulated to consider a situation where only 122 would apply and 74 would not apply. When 74 was drafted, perhaps the view would have been that for every person, entire proceeding has to start with tax first, because it's a tax law. Penalty, interest are all consequential. So if there is no tax to be demanded, then where is the question of giving the person that option to pay any amount and abate the proceeding? So it is with that mindset that people would not have visualized a situation where board itself would come out with the circular saying that no tax to be recovered, only penalty to be recovered. So that aspect, so we can expect a amendment in 74, bringing some kind of put this 15% qua the penalty and not qua the tax for 122 situations. So that is that. Another interesting aspect, now that is very interesting to see. Now if you look at 74, what it says, that what is, when it would be attracted when a person has not paid, short paid the tax, or where input tax credit has been wrongly availed. Interestingly, when you go to the penalty clause under 74(1), it says what can be imposed is that a penalty equivalent to tax specified in the notice, not input tax credit specified in the notice. There can be a situation of non-payment, short payment of tax. That is one situation covered under 74. Another situation is availment of credit. Third situation is erroneous refund. When it comes to levy of penalty, it talks only about penalty of the tax specified in the notice, not the ITC specified in the notice or erroneous refund specified in the notice. Again, something where we can expect a retrospective amendment soon under 74 and 73 to link this, because in excise, this was much clearer. In excise, we had penalty equivalent to tax or convert credit or refund. Here we have only tax as a base to levy penalty under 74. So again, this circular saying that under 74, you can penalize C is not something which is coming up from the language of 74 as far as the wrong availment of credit, input tax credit is concerned. So again, that's something that circular would have to be reconsidered. See, there are larger issues also here of determination of the penalty vis-a-vis B. Now see, 7513. If you see the language of 7513, let me read that language. What it says, where any penalty is imposed under 73 or 74, no penalty for the same act or omission shall be imposed on the same person under any other provisions of this act. So this covers a situation where penalty is imposed under 74 and then 122 cannot apply. Circular says that for B, 74 does not apply. Because B has done what? He has done trading in invoices. A has done what? He has done manufacturing of invoices. So for A and B, 74 does not apply. Only for C, 74 applies because credit is to be recovered. And since credit is to be recovered from C, because he has consumed the credit, since 74 applies and penalty under 74 applies, which as we discussed is debatable, still assuming a penalty under 74 is leviable, 122 then does not apply, which is right. But for B and C, what wrong they have done by denying them the benefit under 7530? Why I am saying specifically for B. See, for A, penalty is only once, so that is fine. There is no double penalty on A. Now, what B has done? B has taken an invoice of 100, issued another invoice of 100. Can we say that he has committed two offenses? One of availing the credit and another of issuing an invoice without underlying supply. Circular says he has committed two offenses, and therefore they say 200 rupees on B. I would say that principle of 7513 should equally apply here on B also, because offense is only one of buying and selling invoice. You cannot break an offense. Like for example, if someone is murdering a person, to murder that person, he is purchasing a knife, he is arranging a transport, and then going to that person and killing that person. You cannot split that into a multiple different offenses and say that buying a knife with an intent to murder is one offense, arranging a transportation with an intent to murder is another offense, and then actual murder is a third offense. No, it's a singular offense. There is a criminal law which is well settled on that, and that is why this double jeopardy comes from that basis. So here for B also, I don't see how you can say that there is a double offense that he has committed. Ultimately, it's a single act of passing on the fake credit. That single act cannot, that there can be a double claim or two different claims that he could have had under law. But as far as act is concerned, it's a singular act of passing the fake credits. The word used under 7513 is act, not claim. And therefore, one has to relook from that perspective whether B can be saddled with 200 rupees when what he has done is only avail and passed the fake credit of 100. So I think these are some preliminary issues that on this topic.
Very insightful, Abhay, very insightful. I would say quite legally you've deciphered this entire circular. Certainly all these legal issues are going to be there. A few aspects which I would like to just add here is, which Abhay has also mentioned, is that is it giving leeway to the people who are creating fake invoices? Because creators are being told that, okay, no demand of tax and demand of penalties being only the one that's there. So this is one issue that's going to come. Second, very important aspect is, again, a legal question that comes is that when we look at section 122, it says penalty equivalent to the tax evaded. Now, in this scenario, if I see B, and the penalty has to be looked at tax evaded call the B. Now, B per se has not evaded the tax. What B has done is that B has been an intermediary. He wants to show something more in his bank account because he wants the loan. So he has taken some bills and he has given some bills again. So there is no tax evasion per se on B. The tax evasion, even if it is there, maybe C or D or E, whatever, but not B. So the computation of penalty of equal to the tax evaded, where that question comes, and how the aspect of tax evasion on part of B needs to be proved. That is very, very important aspect. And whether the tax has been evaded by C, who is the immediate customer of B, also has to come out to be imposing a penalty on B. Let us say, even if the interpretation has to be taken that tax evasion need not be called the person. So that thing also needs to be come out and proved in the notice to be imposing a penalty on B. It's very important. It's very easy to think about this when we look at A, B, C, but in a real scenario, A doesn't know B, B doesn't know C, and C doesn't know D. Now, in this entire thing, department is going to keep all of these 4 people in dark and take from A, B, C, D, everybody, because there's no common platform, correct? So ultimately, this is going to happen from all. And when we look at, when we see people facing this fake invoicing thing, they don't know who is the, they at times don't know the person from whom this has come. So this A, B, C, D is looking very easy in circular, but in reality, I think it's going to be very complex.
One should only pray that all these 4 cases are not up for hearing on the same day, because all the 4 will be making contradictory arguments.
Exactly.
Excise, we had similar instances, and then we had to then take another date insisted, because it used to happen that the person from whom I have purchased, department used to allege all are fake. He would argue something else. I may want to argue contrary thing, and all the hearings are put on the same date, and then the advocates will fight.
So all these funny things are going to be there in future. One another dimension is that a lot of people in last 2, 3 years, 4 years, out of coercion, pressure, harassment, ended up paying, even in the case of B, a lot of taxes. Good opportunity for them to actually file an application for refund, I would say. But then, of course, there are taxpayers who would say, "Abhi ho gaya, kyun udhar fir se jaye?" Of course, everybody would have their own view, but then certainly one aspect can be looked at. Okay, so this is on the fake invoicing circular. We've tried our best to decipher that. Next amendment, I would say more of a procedural aspect, which was actually quite clear to everyone that this proviso has to be read for entire 17.5, that subclause 3. But then there was some interpretation. That's why they have clarified this particular amendment and the next amendment as well. I would say the procedural aspect, not much here. UPI IMPS is also now being made as a mode of payment. Earlier it was NEFT, RTGS, which was there. Abhay, anything you would like to add on that?
No, fine. Yeah, absolutely. I think quickly we can cover.
Yeah, correct. And this next one is, again, I would say a very clear amendment. Electronic credit ledger can be used not just for self-assessed tax, even for other payments. Which is a very good amendment, because a lot of times people started saying annual return you need to pay only in cash. In the time of investigation, you need to pay only in cash. You cannot use pre-deposit. You need to do only in cash. All these questions were come. Good. This circular has come, which has mentioned that you can use electronic credit ledger not just for self-assessed tax in the return, even other payable as a consequence of any other proceedings instituted.
See,
so,
here if I,
yes, Abhay, please. I think that's all I had to say here. So you can add.
See, here on that pre-deposit, in fact, it's a very interesting issue, because if you look at circular in a way, it says, yes, you can, the law says you can pay output tax. The law does not say that output tax has to be only paid through return. So even output tax paid otherwise would be, you can use the credit ledger. Now the question comes that, let us say there is a show cause notice saying that you have availed some erroneous credit and you have utilized that. So basically the department wants to recover, and that matter is, order has been passed against you, and now you want to go into an appeal. Now, whether for this disputed amount, can we pay the pre-deposit by utilizing the balance that could be available with the taxpayer from in the credit ledger? Now, output tax, if you see the definition, it is given under clause 82 of section 2, which says it's a tax which is chargeable on a taxable supply and excludes the tax payable under reverse charge. So basically, by this circular, a department would take a view that now they would categorize pre-deposit into 2 categories. One is where output tax is disputed. There, the circular will help to say that, yes, since output tax is disputed, I can discharge that tax even in terms of a pre-deposit by utilizing the balance in the credit ledger. But where input tax credit is disputed, and in that situation, if I want to pay a pre-deposit, it may be possible that at that point in time when I want to file an appeal, balance could be there in my credit ledger, maybe some other credit that I would have earned. That because of this circular, the department would take a view that that would not be payable. You will have to pay that pre-deposit in cash, where ITC is the disputed amount and not the output tax. So that would be something that I think one has to consider.
Correct. Yes. Coming to the next amendment, again, I would say we told GST, compliances will become easy and all these things. So your GST or 3B is going to become more complicated. First two aspects are in the context of electronic commerce operators. When these restaurants were moved to the, Swiggy need to pay tax on restaurant. The first question that came is, where does a Swiggy declare and where does a restaurant declare? There is no, mechanism in the GST or 3B, which they have inserted this for both Swiggy to declare as well as a restaurant to declare this e-commerce operator tab, which is, I would say, well needed. Now, the next aspect is little critical. Your entire credits till now were going in, I would say, one liner or two line basket, but now it has to go in 2 to 3 different aspects. One is permanent reversal of credits, something that is permanent, 17.5, Rule 38, Rule 42, 43, permanent reversal of credit, no question of reclaiming, has to go in a separate basket. Your temporary reversal of credits, which are reversal and reclaim, let's say relating to GSTR 2B, and of course, once this Finance Act 2022 amendment comes in play, this reclaim related aspect, which is there, the revised section would also come into picture, revised section 41. So that has to be separately basketed and declared. And the next one is your reversal in the context of incorrect place of supply and 16.4 time limit. So all these things, I would say, they want this breakup because they were change in place of supply is basically to settle the claims with the state. But then this is all going to increase huge compliance, efforts. This also gives a very strong interpretation, which we were always claiming and kind of substantiates, is that the claiming of credit has to be looked at, and the section 16.4 time limit has to be looked at only at the original availing and not at the re-availing. So all these 2A, 2B related issues, which were, on the re-availment, this was being questioned. Actually, this particular amendment kind of indirectly gives this clarification, which was already there under SENVAT in certain, I would say, situations. So all in all, I would say this is one aspect of GSTR 3B amendment, which was there. These are more of amendments in the 3B. The next is more of a clarificatory in a 3B aspect, where when you supply to URD or composition taxpayers or UIN holders, this place of supply details is important to be given, so that there is again a settlement with the states needs to be properly taken care of. And that is where this amendment is there. And if you do any amendment in GSTR 1, it has also be carried out. Many businesses were not disclosing this in GSTR 3B because that was only a disclosure field, and the tax was anyway considered in 3.1, not 3.2. And there was a difference between what was there in GSTR 1 and GSTR 3B. So now this is going to be another big, I would say, a headache, where state-wise that pop-up is going to come. Your GSTR 1 will be linked. Somewhere this GSTR 3B is now moving more towards GSTR 3, looks like, with the name GSTR 3B. So all in all, the compliances in GSTR 3B are going to increase substantially because of the settlement to be taken up at the between the states. Abhay?
No, absolutely, it's fine. I am only wondering that, let us say, if one files ignoring this, what happens? His credit still remains eligible. Tax already he has paid. So 74, 73, no recovery possible. Perhaps 125, maybe general penalty could get imposed.
Ideally, that should be the only one which should be there.
This is mainly to do with their fund settlement rather than taxpayer getting any benefit.
Correct.
It's their work that they are asking the taxpayer to do.
Correct. Exactly. Correct. So, and this is going to only, a very important question Abhay is raising, that okay, ठीक है, miss हो गया, ऊपर A में देने का B में दे दिया. This is going to happen. So then, what is the implication? And does it mean that reclaim will not be allowed or whatever? That is going to be a very big issue, I would say. GSTR 99C, no much major amendments per se, but only these HSN details are required at up to 5 crore turnover, less than 5 or 6-digit level, which if businesses are already reporting in GSTR 1, they would not face a problem, but otherwise this would be an additional compliance even for this current 990 that needs to be filed. Other than that, all the relaxations earlier that were there are more or less continued in the upcoming GST and 99C as well. So nothing much over there. Okay, Abhay, these are a few other procedural aspects. The first one is a little important, so you can just take up that one, and rest I think are anyway not much critical.
See, basically, this deals with a situation where your officer feels that since you have not filed the returns for a certain timeline, you are fishy, you are suspicious, so your registration is required to be cancelled. But before cancelling the registration, we will first have to suspend it. So they suspend the registration. Meanwhile, you file the return and you approach the officer and ask for the revocation of that suspension. The officer was to say that no, since we already suspended and initiate the proceedings for cancellation, we'll continue with those proceedings. We'll issue a notice for cancellation. You reply, and if you find satisfactory, then only we will revoke. Otherwise, we'll cancel your registration. In this situation, since returns were pending, only thing that was required was to file the return. Now, if he commits an offense, otherwise, for which he is liable for cancellation, that could be a separate proceeding, which anyway the officer can initiate even at a subsequent point in time. So there is no point of linking that suspicion with a suspicion of he undertaking some fake activity or like that, and keep that matters lingering for months, and then that particular business has to suffer, because once your registration is suspended, you cannot issue an invoice, you cannot generate an e-way bill. So there are a lot of other problems that you have to face. So now this notification says that automatically your suspension would be revoked if you file the pending returns. If return pendencies was the only ground to suspend your registration. So that I think is fairly good. Only problem is there is some drafting lacuna in this notification. Actually, for non-filing of the return, if your number is suspended, it is suspended under sub-rule 2. Here they have referred to sub-rule 2A of Rule 21. So that I think is a mistake. Probably a corrigendum would get issued to rectify that error. Other than that, I don't think there is anything else. Rest, I think 2 crore, I think it's fine. Up to 2 crore annual return is not compulsory. Late fees waived for 21-22. I think GSTR 4 has to be filed, I think, by 28th of July. No late fee would apply. And this CMP 08, that is this composition payment form, I believe, for that first quarter, the due date has been extended to 31st of July.
Correct. Yes. So I would say now, these are a few other amendments that are not yet notified. So I would not get into the discussion on these amendments per se. As such. Maybe now what we can do is all these amendments that are already notified have been covered. We have got 15 minutes. I would actually put it up to Rajesh as to how do we take this up, because now we would require possibly another 15 minutes to.
Yeah, it's 15 minutes. Yes, sir.
But then Q&A possibly, I see the session may get extended for 5 to 10 minutes for Q&A. That's okay.
Okay, sir.
Okay, fine. So maybe I'll cover 2 sectors and Abhay can take up other 2 sectors, and we'll kind of close this. So this branded foods has always been a contentious issue, as much as that, multiple times that amendment got that particular notification, that aspect which was there in notification number 1 and 2 got changed. So it was mentioned that if it is a branded food, registered brand or unregistered brand where actionable claim is being, given up, so there would be exemption, and even if the tax which was there was reduced rate 5% or 12%. So there are a lot of questions on what do you mean by brand? Does the brand mean the brand of the product, or even the company's brand? Company itself has got a reputation of its own, would also be considered a branded. So a lot of confusion, multiple advanced rulings. I would say a couple of high court judgments were also there in this context. This now government has found a wonderful opportunity to say that because of this issue, we want to, kind of clarify this. It would have been okay if they would have clarified this, but they have not just clarified, they have extended the tax base substantially by now referring this to Legal Metrology Act, wherein it says that if it is pre-packed and pre-labeled retail pack, then only it would be taxed, otherwise it would not be taxed. Now, when we look at the definition of pre-packed and labeling in Legal Metrology Act, is pretty wide to cover, any mark, stamp, or pre-packaging before the buyer comes in. Now the important question that comes is how this amendment is going to be eventually be implemented. Because the term retail pack as such, we do not find in legal metal acts, then the legal metal commodity rules. Now that rule per se does not talk about the 25 kg, 50 kg bifurcation, but that applicability of rules look at this 25 kg, 50 kg bifurcation, which is there. So should we look at how do we really read this term retail pack is as of now not clear. Another very important aspect is there are few exemptions to the Legal Metrology Act and that particular rules. Now, how this wordings has to be read, whether it has to be simply read as a definition taken from the Legal Metrology Act or the applicability of that also act to this product would also have an implication is something we need to wait for the notifications to come. But all in all, this is going to have a huge implication. And I see a big parallel economy coming in because of this particular issue. Like, for example, yesterday I was discussing with someone. I told that this is going to be a very big issue. They just asked me something back and I couldn't answer. Sir, 2 साल बाद कैसे पता चलेगा कि प्री पैक में दिया था या खुला दिया था? And I was like, oh, okay. So that is going to be, leading to a lot of anomalies over here. But then I would not like to conclude or talk anything much more on this because once the notification is there, only then we need to decipher this. But it is going to certainly increase the tax base and hit the retail merchants. Abhay, quickly, anything here?
No, fine. I think better once notification comes, probably we'll be able to better examine.
Yes.
But I agree, it will increase the tax base.
Ravi sir, that
Yes.
sugar we are packing in a 50 kg bag, can you call it as a pre-packaged sugar?
No, once it is packed, see Rajesh, if it is packed already without the customer being in there, यानी मेरे shop में मैंने already pack करके 25 kilo, 50 kilo का, I have done the packing and kept it ready with proper label and all those whatever that is there, then it is pre-packaged only. But let's say if it is there in one gunny bag in the shop and a customer comes, I just pick up a sugar and wait then and there and give it, then it is not pre-packaged. Are you getting it? So, but then this 50 kg, 25 kg itself, whether we need to apply or how we need to apply, we need to wait and watch. Warehousing, I would say one important amendment that is critical for us to understand, rest all are, I would say, procedural amendments, is this GTA, transportation business. Till now, it was 5% under reverse charge, 12% under forward charge. And once you have opted for particular type of, a mechanism, then henceforth, it can only be that mechanism. There's no mechanism to switch per se. So now there are two aspects that they have brought out here. One is that as a GTA transporter, I can actually be under forward charge or reverse charge. I can switch at the start of the financial year. Now this switch is good, but then it's going to impact how the reversals are calculated. 1 year you are in forward charge, next in taxable exempt, which is reverse charge is considered as exempt. So how this, if let's say a transporter purchases trucks, so for them, reversal and reclaim of credits is going to be a very big issue in the calculations that needs to be taken care. Now, very important aspect is that under forward charge itself, a transporter can possibly go for both 12% and 5% as per the language of the recommendations, which means I can say that for customer A, I will go under 5% forward charge, no ITC. For customer B, I can go under 12% forward charge ITC. So all those issues of common ITC, reversal, and all this thing is going to be there. So this is mainly, I would say, in few transportation businesses, it is more of customer driven, and few customers would say that no, for us, you do it like this only. So that is how this problem is going to come. At the recipient's end also, there is going to be very big problem. Then he need to have that headache of understanding which transportation. Till now it was transporter wise. क्या करते थे? भाई ये transporter forward charge में, ये transporter reverse charge में. But now what is going to happen is that it has to be transporter wise, invoice wise. Few transporters will be under forward charge, few under reverse charge, few under forward charge with 12 and 5. So at recipients angle, all these manufacturing companies would have to communicate with the transporters and kind of recheck this, their charge, what they're going to do. And for transporters, logistics companies, they need to decide what is the best strategy for them in this particular thing. Anything here, Abhay?
इसमें रवि भाई, I would only say perhaps the intent is not to cover a situation where someone is already under reverse charge and to permit him to come under forward charge and then do those ITC calculations of what is eligible for the truck. Intent is those who are under forward charge. For them, whether they don't want to avail ITC and pay 12% or not avail ITC and pay 5%, that would open up. That perhaps, because that is how the language, I just saw the press release also. So on the forward chart, they want to open up those options. And then they are saying RCM option to continue would mean that status quo as far as RCM is concerned will continue. Of course, there is a legal issue involved that whether someone can a notification bind a person permanently if someone has gone under reverse charge, and if the notification does not have any time frame within which he should remain in that reverse charge, can he come out, how he can come out, when he comes out, how to calculate the admissible credit. All those aspects are not there in the notification, but that's a purely legal aspect. I think here what they are trying to say is that someone is under forward charge right now has to compulsorily pay 12. Henceforth, he will get an option to pay 5 and not avail the credit on the trucks that he purchases or those things.
So Abhay, you are saying that, let's say I can either be under 5 or 12, not both in the same financial year.
No, I am saying you can be either under forward or reverse for your business. Once you are under forward, then you can be under 5 or 12. Now, that option, either or, but that option has to be selected at the start of the year. So if let us say at the start of the year, I have selected 12, then I can avail the credits. Now at the start of the next financial year, if I now select 5, then qua the trucks that I have already purchased and avail the credit, there would be some mechanism coming to reverse that credits.
Okay. Because my reading, because I've read that, I remember reading that particular thing 2 or 3 times. My reading was that they are giving both 5 and 12 in the same financial year qua the supplies. But then I would rather not go into too much of interpretation of the recommendations.
Better to. That is why, in fact, we kept this at the last, because this is
like we need to wait for the notification to eventually interpret that. So this is on the transportation. Rest are, I would say, procedural. We need to wait for the notifications to look at discussion on those. Abhay, I think quickly on this infrastructure works contract and then hospitals and then that accommodation side. 3 sectors.
On the real estate side, I believe if as I remember, there are 3 broad recommendations on that. One is the exemption that is right now available on a residential unit. That they are saying that exemption would be withdrawn if that residential unit is rented to a registered person. So a person who is undertaking a business activity. So for example, many times it happens that these companies take certain residential flats on rent for their employees. So as an owner of that flat, right now I am claiming an exemption under GST law because for me it's a residential dwelling that I have rented. So it falls under the exemption category. Now they are saying that no, if you are giving it to a registered entity, it will not be exempted. So in such situation, many property owners right now, residential owners, might come under GST net because of this withdrawal of that exemption qua the business entity. So that is one amendment. Of course, language one has to see how it comes and whether there is an option of reverse charge that they are going to come or they will make these property owners liable for registration. That aspect only time will tell. But that is one. Second, they are saying that sale of plot, if you do certain activities like they've given some illustration like drainage leveling, etc. Now we don't know what that etc. means, but drainage leveling is what they have used. If that is what they do and sell the plot, it will not be liable to tax. So they basically are trying to interpret the word sale of land under Schedule 3 by saying that that would also encompass even such transactions where you do some kind of leveling, but you don't alter the basic characteristic of a land. It continues to be the land. But perhaps the principle that one can derive, this is I'm saying from the basis of the court's view, not from the amendment that would come, is that if you are going to alter the characteristics in the eyes of a layman, then perhaps that there would be a supply element that could get embedded. As long as you don't alter the basic characteristics and continues to be land, then leveling or drainage or such activities would not bring the transaction into GST ambit. So that perhaps in that line something is expected. I think this already we have covered. Land we have covered. I think on the real estate side, Right. In that long-term lease, they have said something. Just let me pull that up. I think it's a very contentious issue. But there is some GST Council this thing on the long-term lease. They are saying allowing choice of location of a plot is part of supply of long-term lease of plot of land. Therefore, location charges or preferential location charges are part of consideration charged for long-term lease of land and shall get the same treatment under GST. So again, this will continue with that vexed issue of whether long-term lease of land, mainly this industrial land beyond 30 years, whether that can be brought to tax in a situation where there is an assignment. So original, let us say, industrial corporation gives a long-term lease to A, that is exempt if that lease is above 30 years. But when A assigns that right to B, whether that transaction is taxable or not, that controversy still continues to be there. As an addition to that controversy, now I think council is saying that in that transaction, if you receive some additional charges for location or something like that, even that would be liable to tax. So that is something which I think only time will tell how that would come. I think these are the three major changes that I can see from the real estate side.
I would say, Abhay, you can just also quickly cover the stay PGs related thing and the hospitals related. I think these are the only two sectors which also have these amendments impacting.
See, hospital is something, again, probably once it comes, it may take maybe 2 hours to dissect and understand, because it's very ironical. I don't know what they have there. On one hand, healthcare service is exempt. We have a concept of composite supply, which says principal supply is what determines the tax liability. And now they are saying that no hospital beds other than ICU. Now, I don't know whether they want to show some mercy to a patient who is in an ICU. So a patient in an ICU may pay above 5,000 and avoid GST, but a patient who is not in an ICU, means a relatively fit person, is in a position to then work and arrange for the GST payment that is to be made on that amount that will be paid. So that is again something which is one has to see. There will be huge controversy. Let me tell you, many hospitals would resist, because right now the way they are structuring the transaction, they are basically focusing on the insurance companies and then giving the bifurcation of the treatment charges. Now to consider the GST factor and then open market value, and because we have multiple supplies, how to apportion the value qua which supply, again all those open issues will be there. Another issue that we have in the this housing society, that the language is exceeding 5,000. So whether only, let us say 6,000 is charged, then only that 1,000 would attract GST, or entire 6,000 would attract GST. Again, only on the language of that notification we can know what is the intent. But let me tell you, hitting a sector, and either one has to hit a sector, I believe one should hit it comprehensively. Hitting a sector in this manner by picking some element, creating a huge amount of ambiguity, and saying that this would attract tax, rest all will continue to remain exempt, I don't think is a good administrative decision. Of course, legally they have the powers to do it, but administratively it would be a nightmare to really comply. It will be a big challenge. That would be it.
Couple of things in the hospital, which I would like to add is that one is, Mr. Tarun Bajaj gave a statement that if a person can afford 5,000 rupees for a bed in a hospital, he can always afford 250 rupees for the GST. I would strongly disagree for that particular statement. It's not about 250 rupees, but we need to understand that it's not only the affluent class who go for the, all these larger hospitals, because today even the non-affluent class, because they need a particular facility which is there only in the larger hospital, they end up going to that hospital. So a hospital, you don't go, because of it, the room is 5-star or something. You go for that treatment, that doctor, that care is there only in that hospital. So that is an absolute wrong statement. That hospital, nobody goes for luxury. I don't know how he makes this statement. This is one point. And second is, we need to understand, whatever hospitals, they are not going to get credit anyway. And whatever they are going to charge, the recipient will also not get credit, because health services will block credit. Now, for insurance company, it's going to be a big blockage of credit, which I am seeing, unless they interpreted that section 17.5D, that particular thing as a composite supply of this particular thing and claim. But otherwise, that is another issue the recipient is going to face. But we need to wait for the amendment to come in and evaluate. Last is PGs. All your dharamshalas, lodges, inns, accommodation for hospital nurses, guest house, plus your small hotels. Everybody is now coming under tax net because basic accommodation for residential also is not being covered. Both when they take it as a renting or as a this thing, the renting side may come under reverse charge. But another issue that is open over there is there is a dichotomy in the rate, because if you treat it as a renting, then it goes under 18%, but if you treat it as accommodation service, it goes under 12%. So still that long-term, short-term issue is going to continue for the 6% of difference that has been created. So again, I would say we should wait for the notification to analyze this aspect as well. Abhay, anything here?
No, I think better we wait, because whatever we speak, perhaps some participants would get more confused.
Okay.
I think better wait for notification so that we can have some concrete answers.
Discussion on this aspect. Yes. Then these are, I would say, few clarifications on which again the notifications have not come. Maybe one more session can happen once the notifications are out.
See, on ice cream, it is very important. Let me tell you. I mean, what will come is very clear from what the press release is, so we can discuss and we know what has happened. See, for ice cream parlor, what they said in a circular that they issued, I think somewhere, let me see, I had opened it up. Circular number 164, that was dated 6th October 21. Now, what they say that an ice cream parlor basically only sells manufactured ice creams. And since it is already a manufactured ice cream, even though it has a service element, and they have recognized in that circular that yes, it can have a service element. There can be seating facility, there can be a service of serving that ice cream. Based on the taste of the consumer, they may prepare or add some ingredients over the top of that ice cream. So they agree there is a service element, but prima facie they are saying it is a manufactured ice cream that is supplied. Second, it is not a restaurant premises, because restaurant premises, the way it has been defined in a notification, includes a proper sitting space. So they are saying it is sale of goods, and therefore it will attract GST as supply of goods. So it would be 18%. Now they are saying that, look, this week issued on 6th of October 21. Now what happens to a situation till 5th of October of 21, where people have paid 5%, because earlier the view was that since it's a supply of food, service element is embedded, it is a composite supply, and once it is a composite supply, Schedule 2 says it will be deemed as a supply of service. Once it is deemed as a supply of service, there can be not a question of it considering a supply of goods. And then they interpreted the restaurant service in a broad way. Initially, in fact, there was no restaurant service. At a later point in time, this restaurant service definition came into law. And even a restaurant service, if you refer to the explanatory notes, it says eating joint. It uses kind of a very broad terminology, not limited to a regular restaurant that we normally find. So the view was that, look, this is also one kind of a food joint, eating joint, and therefore it qualifies as a restaurant. There is a service clearly, and therefore it would attract a rate of 5%. So now they are saying that we will regularize this to avoid unnecessary litigation. Now, God knows how they will regularize it. The only way I see is that they will say, okay, you pay differential tax. Interest, we will not charge penalty. This would be their way of regularizing what they issued. I don't think, in fact, they should regularize after 6th of October, the mess that they have done by withdrawing that circular, rather than regularizing it by reaffirming the circular and saying that till 5th of October, if you have defaulted, we will allow you a window to pay and clear and close the matter. So I think this is again something not in right spirit. Ice cream parlor, I would take a view that it is a supply of service. It is not a supply of goods. And therefore, even after this 5th of October 21, I don't think it can be considered as a supply of goods. So, but this is something, again, already litigations are pending, petitions are pending. Maybe an addendum one will have to file to now challenge this additional whatever will come as a part of that writ. So again, something totally unnecessary.
Totally unnecessary. And I just imagine a situation where there is an ice cream parlor is also, apart from ice cream, giving a sandwich. So sandwich is a service, but ice cream is a goods. I don't know what logic I try to apply, but why would
logic is very simple, that we have seen since last 5 years. Once a thought comes into a mind of a person who feels he has a power to have his way, that thought will never vanish from that mind. And that power will be then exercised, come what may, to ensure that what thought that person has to be ultimately the law. So that is the mind that we are talking about.
So this would, I would say, department being so deterrent on this taxability, and that circular when it came itself was, confusing, and now they're affirming this will travel up to, again, High Court, Supreme Court. Then I would say next, just a lot of clarificatory aspect. Then a lot of rate rationalization has happened under the garb of removing inversion, which I see is only eyewash. It is not just to remove inversion; it's basically to increase the tax base and collect the revenue. But all these places they mention as if they're trying to give some sort of a benefit to the taxpayer. Nothing doing. I think this is going to hit the consumers for sure. These are all the rate changes. I'll not go into the discussion of one by one. Only one thing which I see is going to impact heavily is loose diamonds, cut and polished diamonds. Again, this Gujarat, this jewelry sector, they protest like anything. I'm sure they must be on roads once the notification comes, because that's another very big issue of increasing tax rate in the cut and polished diamonds. Not the diamonds as a part of jewelry, but otherwise. Yeah, a lot of other clarificatory aspects related to specific industry, not for public at large. Yeah. So these are the various amendments that are there. We've tried to cover. The idea of discussion was for those things where the notifications have come, let's elaborate and have a fruitful discussion. Something that's notification not there, no point in confusing the audience. Thanks a lot, Abhay, for a wonderful
Always a pleasure.
Discussion. It was nice doing this. Over to you, Rajesh bhai.
It was an excellent session, and you made it interactive. That's why how we completed 3 hours, we have not realized.
Thanks a lot, sir.
Aishwarya?
We'll just take up if there are any questions. I guess all are answered. So I hope there are no questions from the participant side. So, sir, I request you to give a vote of thanks.
There was some questions, but I think
I've already answered, Rajesh sir. There's
Answered.
two questions which I've answered.
Yeah, these are already answered. I, on behalf of Pune branch and all participants, I thank Ravi sir and Abhay sir for giving your valuable insights on the topic. Some notifications are not issued. That's why we can't discuss much about that, government contracts and all, health sector, how it will be taxed under composition scheme, and so on. Thank you, both of you, on behalf of Pune branch. Thanks, Aishwarya, for nicely coordinating. Thanks all participants for patient hearing and enjoying the session. Thank you, friends.
Thank you so much.
Thank you, sir.